Perhaps you have a dollar bill in your wallet right now, or maybe you've checked your bank account balance on your phone today. These ordinary moments connect you to an institution you rarely think about, one that works quietly in the background of American economic life. The Federal Reserve. It touches your savings account, your mortgage rate, the price of groceries, yet it remains mostly invisible, doing its work while you sleep, while you work, while you live your daily life. Tonight, we'll trace the gentle story of how this central bank came to be and what it does in the shadows of the financial world. There's no need to concentrate too hard. Let the story wash over you like a quiet stream. Settle in, let your breathing slow, and allow your mind to drift as we explore the sleepy history of America's central bank. Before there was a Federal Reserve, before there was any central authority watching over American banking, the financial landscape was something like a patchwork quilt, each piece operating independently, connected loosely but without coordination. It was a world that modern Americans would find almost unimaginable, chaotic in ways both fascinating and troubling. Imagine the United States in the late 19th century in the decades after the Civil War. The country was growing rapidly, spreading westward, building railroads and factories, transforming from an agricultural nation into an industrial power. But the financial system that supported this growth was fragmented, unstable, prone to sudden seizures that could bring commerce to a halt. There was no central bank. The United States had tried such institutions twice before, the First Bank of the United States and the Second Bank of the United States, but both had been controversial, opposed by those who feared concentrated financial power, and both had been allowed to expire. Since 1836, when the Second Bank's charter ended, the country had operated without any central monetary authority. Instead, there were thousands of individual banks, each operating under its own rules, issuing its own currency, making its own decisions about lending and reserves. Some were national banks, chartered under the National Banking Acts of 1863 and 1864, which had created a somewhat more uniform system during the Civil War. But many others were state banks, following state regulations that varied enormously from place to place. This meant that money itself was not uniform. A dollar was not simply a dollar. It might be a note issued by the First National Bank of Chicago, or the Bank of Commerce in Kansas City, or any of thousands of other institutions. These notes traded at varying values depending on people's confidence in the issuing bank. A note from a solid, well-established bank might be accepted at face value. A note from a distant or questionable bank might be discounted, accepted only at 90 cents on the dollar or 80 cents, or refused entirely. The term wildcat banking had emerged in earlier decades to describe banks that operated in remote areas, so far from civilization that only wildcats lived there, making it nearly impossible for people to redeem their notes for actual gold or silver. By the late 19th century, the worst excesses of wildcat banking had been curbed, but the underlying problem remained. The money supply was inelastic, unable to expand or contract smoothly in response to the economy's needs. This inelasticity created particular problems at certain times of year. In autumn, when crops were harvested and moved to market, demand for currency surged. Farmers needed money to pay workers. Merchants needed money to buy grain and cotton. Railroads needed money to move the harvest to cities and ports. All across the agricultural regions, the demand for cash rose sharply. But the money supply couldn't expand to meet this demand. Gold and silver, the basis of the monetary system, were in fixed supply. Banks had only so much currency on hand. When harvest season arrived and everyone needed cash at once, interest rates would spike. Money would flow from the financial centers, particularly New York, out to the countryside, leaving the city banks drained of reserves. This seasonal rhythm was predictable, repeated every year, yet the banking system had no mechanism to smooth it out. No central institution could inject liquidity when it was needed and withdraw it when the pressure eased. Instead, banks struggled individually to manage their reserves, sometimes successfully, sometimes not. When the strain became too great, when too many people wanted their money at once, when banks found themselves short of cash and unable to meet withdrawals, the system would break. A panic would begin. The pattern repeated with grim regularity through the late 19th and early 20th centuries. The Panic of 1873 began with the failure of J. Cook and Company, a major banking house that had overextended itself financing railroad construction. The failure sent shockwaves through the financial system. Banks that had deposits with Cook or had relied on Cook for credit suddenly found themselves in trouble. Depositors, fearing for their money, rushed to withdraw it. Banks that might have been perfectly sound under normal circumstances found themselves overwhelmed by demands for cash they didn't have immediately available. The panic led to a depression that lasted for years, with banks failing, businesses closing, unemployment rising. The economy eventually recovered, as economies do, but the scars remained, and the vulnerability was exposed. 20 years later, the Panic of 1893 struck. This time the trigger was the failure of the Philadelphia and Reading Railroad, followed by the collapse of the National Cordage Company. Once again, the pattern played out. Fear spread. Depositors rushed to withdraw their money. Banks ran short of cash. Credit froze. The economy contracted sharply. Before it ended, more than 15,000 businesses had failed and 500 banks had closed their doors. These panics were not like modern recessions, where economic activity slows gradually and government policies attempt to cushion the impact. They were sudden seizures, moments when the entire financial machinery seemed to jam, when perfectly viable businesses couldn't get credit, when banks with fundamentally sound assets couldn't meet immediate demands for currency, when the economy lurched to a halt not because of any underlying problem, but because of the system's mechanical inability to function smoothly under stress. The worst of these panics, the one that would finally convince Americans that something had to change, struck in 1907. It began in the autumn, as so many panics did, when seasonal demands for currency were already straining the system. The immediate trigger was an attempted corner of the stock of United Copper Company. The attempt failed, and the speculators who had organized it found themselves in desperate financial trouble. One of these speculators had connections to the Knickerbocker Trust Company, one of New York's largest financial institutions. When word spread that Knickerbocker might be involved in the failed speculation, depositors grew nervous. On October 21st, 1907, a run began on Knickerbocker Trust. By the end of the day, the institution had paid out millions of dollars to depositors demanding their money. The next day, unable to meet continued withdrawals, Knickerbocker suspended operations. The panic spread. If Knickerbocker could fail, what about other institutions? Depositors lined up at banks throughout New York demanding their money. The stock market plunged. Credit evaporated. Banks that has been lending freely days before now refuse to lend at all, hoarding their reserves against the possibility of runs by their own depositors. Into this crisis stepped a private citizen who had no official authority but enormous influence. John Pierpont Morgan, known as J.P. Morgan, was 70 years old in 1907, the most powerful financier in America, perhaps in the world. His bank, J.P. Morgan and Company, sat at the center of American finance. He had organized railroad companies, steel companies, and had relationships with virtually every major financial institution in the country. Morgan understood that the panic, if allowed to continue, would destroy the entire financial system. Banks would fail that were fundamentally sound. Businesses would collapse that were perfectly viable, all because of a temporary shortage of liquid cash. What was needed was a lender of last resort, someone or something that could provide emergency liquidity to the banking system, allowing sound institutions to weather the storm of withdrawals. In the absence of any central bank, Morgan appointed himself to this role. He gathered the leading bankers of New York to his library on Madison Avenue. There, in their wood-panelled room surrounded by rare books and art, these private individuals decided which institutions would be saved and which would be allowed to fail. They pooled their resources, creating an emergency fund that could be deployed to the most critical points. Morgan himself personally guaranteed some institutions, his word alone sufficient to calm depositors' fears. For weeks, Morgan worked around the clock, sometimes sleeping on a couch in his library, coordinating the response to the panic. Gradually, through his efforts and those of the bankers working with him, confidence was restored. The panic subsided. The immediate crisis passed. But the episode left an uncomfortable recognition. The financial stability of the United States, the ability of its banking system to function, had depended on the intervention of a single private citizen, a man in his 70s working from his personal library. What if Morgan had been travelling abroad when the panic struck? What if he had been ill, or less decisive, or less respected? What if no one had possessed both the resources and the credibility to organise a response? It was clear to many thoughtful observers that this was no way to run the financial system of a modern industrial nation. The United States needed some kind of central institution, something that could provide stability, expand and contract the money supply as needed, serve as a lender of last resort in times of crisis. The country needed, though many were reluctant to use the term, a central bank. But creating such an institution in the United States would not be simple. Americans had a long tradition of suspicion toward concentrated financial power. The farmers and small businesses of the South and West feared domination by the bankers of New York. The memory of the earlier central banks and the political battles over them still lingered. Any proposal for a central bank would face significant political opposition. Moreover, there were genuine questions about what form such an institution should take. Should it be controlled by the government or by private banks? Should it be centralized in one location or spread across the country? How should it be governed? What powers should it have? These were not simple questions with obvious answers, and different groups had very different ideas about the proper solutions. The panic of 1907 had made clear the need for reform. But the path from recognizing the need to creating the solution would take years of debate, compromise, and political maneuvering. It would require bringing together people with fundamentally different visions of what American banking should be. It would require overcoming deep-seated fears and suspicions, and it would require eventually a kind of grand compromise that satisfied no one completely, but gave everyone enough to accept the result. The journey toward that compromise began almost immediately after the panic subsided with the creation of a commission to study the problem and propose solutions. But the story of how that commission worked, who served on it, and what they ultimately created unfolds slowly, patiently, across the years that followed, as America moved gradually, almost reluctantly, toward the institution that would become the Federal Reserve. The recognition that something needed to be done came quickly after the panic subsided. Congress, prodded by public concern and financial sector advocacy, established the National Monetary Commission in May of 1908. This was to be a thorough investigation of banking and currency systems, both in the United States and abroad, with the goal of recommending reforms that would prevent future panics. To lead this commission, Congress chose an unlikely figure. Nelson Aldrich was a Republican senator from Rhode Island, chairman of the Senate Finance Committee, one of the most powerful men in Washington. He was 67 years old, a conservative who had spent his career defending business interests and resisting regulation. He was also, at the outset, deeply skeptical of central banking. Aldrich's instincts were for limited government, for allowing markets to function freely, for keeping power dispersed rather than concentrated. But Aldrich was also intelligent, pragmatic, and capable of changing his mind when confronted with evidence. The panic of 1907 had shaken him, as it had shaken many Americans. He had watched the financial system come to the brink of collapse. He had seen J.P. Morgan, a private citizen however powerful, forced to act as the nation's de facto central banker. Aldrich recognized that this arrangement was inadequate, even dangerous. The question was what should replace it. To find answers, Aldrich embarked on an extensive study of European banking systems. In 1908, he travelled to Europe with a delegation of experts, spending months examining how other countries managed their finances. He visited the Bank of England in London, the Banque de France in Paris, the Reichsbank in Berlin. He met with central bankers, finance ministers, and academic economists. What Aldrich discovered surprised him. The European central banks were not the dangerous concentrations of power he had feared. They were in many ways stabilizing forces in their economies. They could expand credit when it was needed and contract it when expansion became excessive. They served as lenders of last resort during financial stress. They provided a currency that was elastic, able to grow and shrink with the economy's needs. And perhaps most importantly, they did all this while maintaining the gold standard that Aldrich, like most people of his era, considered essential to sound money. The Bank of England particularly impressed Aldrich. Founded in 1694, it had evolved over more than 2 centuries into an institution of remarkable sophistication. It held the reserves of other banks, cleared payments between them, managed the government's accounts, and regulated the supply of money through its discount rate, the interest rate it charged when lending to commercial banks. When banks faced temporary liquidity problems, they could borrow from the Bank of England, providing good collateral, paying the discount rate, and receiving the cash they needed to meet their obligations. This discount window, as it came to be called, was the key to the Bank of England's role as lender of last resort. A bank facing a run by depositors didn't need to sell assets at fire sale prices or call in loans from businesses. It could borrow from the central bank, meet the withdrawals, and repay the loan when the panic subsided. This mechanism prevented temporary liquidity crises from turning into permanent failures of fundamentally sound institutions. Aldrich spent hours in conversation with the officials of the Bank of England, learning how they thought about monetary policy, how they decided when to tighten credit and when to ease it, how they balanced their responsibilities to the commercial banks and to the broader economy. He took detailed notes, asked countless questions, and slowly, gradually, his thinking began to evolve. The German Reichsbank offered a somewhat different model, more directly controlled by the government, but with similar functions. The French system had its own characteristics. Each country had adapted central banking to its particular circumstances, its political traditions, its economic structure. There was no single correct model, Aldrich realized. The art would be in designing something that could work in the American context, something that could provide the benefits of central banking while addressing American concerns about concentrated power. When Aldrich returned to the United States, he had been transformed from a skeptic into an advocate for reform. He now believed that the country needed a central banking system. But he also understood that creating such a system in America would require navigating complex political terrain. The farmers and small businessmen of the South and West would oppose anything that seemed to concentrate power in the hands of Wall Street bankers. The bankers themselves would resist excessive government control. Progressive reformers would demand public accountability. Conservatives would insist on maintaining the gold standard and limiting government intervention in the economy. Among those who'd been advocating for central banking reform even before the Panic of 1907 was Paul Warburg, a German-born banker who had immigrated to the United States in 1896. Warburg worked for Kuhn, Loeb and Company, one of New York's leading investment banks, but his real passion was monetary reform. He had grown up in a banking family in Hamburg, familiar with the European central banking tradition, and he was appalled by the primitive state of American banking. Warburg wrote articles, gave speeches, and buttonholed anyone who would listen, explaining how a central bank could provide stability, how it could prevent panics, how it could give the United States a financial system worthy of its growing economic power. Before 1907, most people had dismissed Warburg as a tedious advocate for a foreign idea that wouldn't work in America. After 1907, people began to listen. Aldrich and Warburg found each other, recognized kindred spirits, and began to collaborate. Warburg brought detailed knowledge of European central banking and a clear vision of what American reform should accomplish. Aldrich brought political understanding and the credibility to shepherd reform through Congress. Together, they began to work on a plan, but they needed help. The task of designing a central banking system was too complex for two men, however knowledgeable. They needed to bring together a group of experts, men who understood banking from different perspectives, who could work through the countless technical details that a workable system would require. And they needed to do this work quietly, away from the political pressures and public scrutiny that would distort the conversation before the ideas had been fully developed. In the autumn of 1910, Aldrich arranged a meeting. The location he chose was unusual, a private club on Jekyll Island, off the coast of Georgia. The Jekyll Island Club was a winter retreat for some of America's wealthiest families, a place of privacy and seclusion. In November, after the summer season had ended but before the winter residents arrived, the island would be nearly deserted, perfect for a confidential gathering. Aldrich assembled a small group. Paul Warburg was there, of course. Henry Davison came from J.P. Morgan and Company, representing the perspective of the most powerful banking house in America. Frank Vanderlip, president of National City Bank, brought the viewpoint of commercial banking. A.P. Andrews, an economics professor who'd been working with the National Monetary Commission, provided academic expertise. Benjamin Strong, a partner at Bankers Trust, added practical knowledge of trust company operations. The men travelled separately to avoid attention. They took a private rail car from New York, heading south through the November darkness. The trip itself was part of the experience, hours of gentle movement through the night, time to think, to prepare for the work ahead. Imagine that journey, the rhythmic clacking of wheels on rails, the landscape passing unseen outside the windows, these men knowing they were embarking on something significant but uncertain of exactly where it would lead. They arrived at Jekyll Island on November 22nd, 1910. For the next 10 days they worked in almost complete seclusion. They had brought reference materials, reports from the National Monetary Commission, details of European central banking systems, statistics about American banking. They set up in the clubhouse, spreading papers across tables, filling blackboards with diagrams and organizational charts. The secrecy of the meeting would later fuel conspiracy theories, suggestions of shadowy bankers plotting to control the American economy for their own benefit. But the reality was far more mundane. These were practical men trying to solve a genuine problem. They met in private not to hide some nefarious purpose, but because they needed space to think, to debate, to consider options without every preliminary idea being scrutinized and criticized before it was fully formed. Public policy is often made this way, in quiet rooms where people can speak freely, explore ideas, make mistakes, and revise their thinking without every word being reported and politicized. The central challenge they faced was designing a system that could provide the benefits of central banking while addressing American concerns about concentrated power. They needed something that would be credible to bankers, acceptable to Congress, and tolerable to a public that feared both Wall Street and Washington. The solution they developed was a compromise, a hybrid that tried to balance competing demands. Instead of a single central bank headquartered in New York or Washington, there would be a network of reserve banks spread across the country, perhaps 15 or 20 of them, each serving a particular region. These reserve banks would hold the reserves of commercial banks in their regions, provide discount window lending, and manage the currency supply. Coordinating these regional banks would be a central board, based in Washington, with members appointed by the President and confirmed by the Senate. This would provide government oversight and public accountability. But the regional reserve banks themselves would be owned by the commercial banks that were members of the system, with those banks electing some of the directors of their regional reserve bank. This would give the banking industry a voice in governance and help ensure that the system remained responsive to banks' practical needs. The system would issue a new currency, Federal Reserve notes, backed by gold and commercial paper. This currency would be elastic, able to expand when the economy needed more money and contract when the need diminished. The mechanism for this expansion and contraction would be the discount rate. When the reserve banks wanted to encourage borrowing and expand the money supply, they would lower the discount rate. When they wanted to restrain credit, they would raise it. It was an elegant design in principle, though of course the details were enormously complex. How exactly would the regional boundaries be drawn? How many directors should each reserve bank have, And what should be the balance between banker-elected and government-appointed directors? What should be the reserve requirements for member banks? What assets could banks use as collateral when borrowing from the discount window? What should be the penalty for banks that failed to meet their obligations? For 10 days, the men on Jekyll Island worked through these questions and hundreds more. They debated, compromised, revised, and refined. Warburg brought his knowledge of European systems, suggesting adaptations that might work in the American context. Davison contributed the perspective of high finance. Vanderlip offered insights from commercial banking. Strong provided practical operational details. Aldrich chaired the discussions, kept them focused, and ultimately made the decisions when the group couldn't reach consensus. The work was intellectually demanding but also strangely peaceful. The island was quiet, the November weather mild. They took breaks to walk along the beach, to clear their minds, to let ideas settle. The rhythm of work and rest, intense discussion followed by quiet reflection, allowed them to make progress that might have been impossible in a more hectic setting. By the time they left Jekyll Island in early December, they had the outline of a plan. It would need refinement, legal drafting, political massage. But the core structure was there, a decentralized network of regional reserve banks, coordinated by a central board, providing an elastic currency, serving as lender of last resort, maintaining the gold standard, balancing public and private control. Aldrich returned to Washington and worked with staff to transform the Jekyll Island discussions into a formal proposal. The result, introduced in January of 1911, became known as the Aldrich Plan. It called for a National Reserve Association with 15 regional branches, governed by a board with representation from member banks and the federal government. The plan maintained the gold standard, created an elastic currency, and provided for a discount window where banks could borrow during times of stress. Aldrich believed he had crafted a careful compromise that addressed the legitimate concerns of different constituencies while providing the central banking functions that the country needed. He was confident the plan would pass Congress, perhaps with some modifications, and that the United States would finally have the financial stability that European nations had long enjoyed. But Aldrich had misjudged the political situation. His plan, despite its attempt at balance, was seen by many as too favourable to bankers, too much a creation of Wall Street. The fact that it had been developed in secret, even though that secrecy had a practical purpose, fed suspicions. Progressive reformers attacked it as a banker's scheme. Southern and Western Democrats representing agricultural regions that had long distrusted Eastern finance opposed anything that seemed to concentrate monetary power. The 1912 election intervened. Aldrich's Republican Party split, with Theodore Roosevelt running as a progressive against the incumbent William Howard Taft. The Democrats nominated Woodrow Wilson, a former professor and university president who had become governor of New Jersey. Wilson won in a divided field, and the Democrats took control of Congress. The Aldrich Plan was dead. Republicans had lost the power to enact it, and Democrats would not pass a plan so closely associated with Republican banking interests. But the ideas in the Aldrich Plan, the structure worked out on Jekyll Island, would not disappear. They would be transformed, repackaged, made more acceptable to Democratic constituencies, and ultimately enacted in a different form, under a different name, serving the same essential purposes. The work that began on Jekyll Island in November of 1910 was not wasted. It was simply incomplete. The next chapter in the story would require different actors, different political manoeuvring, and different compromises. But the intellectual foundation had been laid. The question was no longer whether the United States needed a central banking system. The question was what form that system would take and who would control it. Woodrow Wilson arrived in Washington in March of 1913 knowing very little about banking. He was 56 years old, a scholar by training and temperament, the son of a Presbyterian minister. He'd spent most of his career in academia, teaching political science at Princeton, and serving as that university's president before entering politics as governor of New Jersey. His expertise lay in government structure, in constitutional questions, in political theory. The intricacies of monetary policy, the mechanics of central banking, the debates over reserve requirements and discount rates, these were not subjects he had studied deeply. But Wilson was intelligent and capable of learning. More importantly, he understood that banking reform was essential. The panic of 1907 was still fresh in memory. The need for a more stable financial system was widely recognized. And Wilson, despite his lack of expertise in banking, possessed something perhaps more valuable. He had no fixed allegiances to either the banking industry or its critics. He could approach the question with an open mind, listening to different perspectives, seeking solutions that would serve the public interest rather than narrow constituencies. Two men would become Wilson's principal guides through the complexities of banking reform, both Democrats, both bringing very different perspectives to the task. Carter Glass was a congressman from Virginia, a small, intense man who chaired the House Banking Committee. Glass had studied banking questions carefully, had watched the development of the Aldrich Plan with interest, and had his own ideas about how reform should proceed. He was a states' rights Democrat, suspicious of concentrated federal power, but he recognized that some kind of central coordination was necessary. Louis Brandeis brought a different sensibility. He was a lawyer, a reformer, known as the People's Attorney, for his advocacy on behalf of consumers and workers against corporate power. Brandeis had written extensively about the dangers of concentrated financial power, about what he called the money trust, the small group of New York bankers who seemed to control access to credit for the entire country. Brandeis believed deeply that any new banking system must prevent such concentration, must ensure that financial power remained dispersed and accountable. Wilson met with both men repeatedly during the spring and summer of 1913. Glass would present technical details, explaining how reserve requirements worked, how the discount window would operate, how the regional structure could provide stability while maintaining decentralization. Brandeis would raise concerns, asking how the system would prevent banker domination, how it would protect the public interest, how it would ensure that credit flowed to productive enterprise rather than speculation. Slowly, through these conversations, Wilson developed his own understanding of what was needed. The Aldrich Plan had contained good ideas, he came to believe, but it had given too much control to private bankers. The new system would need stronger government oversight, clearer public accountability. At the same time, it couldn't simply be a government bureau run by political appointees who knew nothing about banking. It needed the expertise and practical knowledge that came from actual banking experience. The solution that emerged was a modification of the Aldrich Plan structure. There would still be regional reserve banks, but perhaps fewer of them, 12 rather than 15 or 20. These reserve banks would still be owned by their member banks, maintaining some private character. But the governing board in Washington would be appointed entirely by the president and confirmed by the Senate, with no direct representation from the banking industry. This would establish clear government control while preserving the regional structure and operational expertise. Glass worked with his staff to draft legislation incorporating these principles. The drafting process was painstaking, working through countless technical details. How should the 12 regions be determined? What criteria should guide the selection of reserve bank cities? How should the governing board be structured? How many members? What qualifications? What terms of office? Each question required careful consideration, balancing competing concerns. If the regions were too small, the reserve banks would lack sufficient resources and expertise. If they were too large, they would be remote from the banks they served. If board members served long terms, they would develop expertise but might become too independent. If they served short terms, they would remain accountable but might lack continuity. Glass consulted with banking experts, with academic, economists, with business leaders from different parts of the country. He incorporated suggestions, rejected others, revised and refined. The work consumed months through the hot Washington summer of 1913 into the autumn. Meanwhile, Brandeis worked on Wilson, ensuring that the final legislation would contain adequate safeguards against banker control. The discount rate, the key tool for expanding or contracting credit, must be set by the government-appointed board, not by the reserve banks themselves. The reserve bank should be supervised by the board, subject to examination and regulation. The currency issued by the system should be obligations of the United States government, not private banknotes. These provisions made the plan more acceptable to progressive Democrats who feared Wall Street domination. But they made the plan less acceptable to bankers who worried about political interference in banking decisions. The banking community was divided. Some bankers, recognizing that some reform was inevitable, supported Glass's bill as a reasonable compromise. Others opposed it, arguing that it gave too much power to government, that it would lead to inflation and financial instability. The debate in Congress through the autumn of 1913 was extensive but, for the most part, thoughtful. This was not a partisan issue in the usual sense. Some Democrats opposed the bill as too favorable to banks. Some Republicans supported it as necessary reform. The fault lines ran in different directions than the normal party divisions. Glass defended the bill in the House, explaining how it would prevent future panics, how it would provide an elastic currency, how it would maintain the gold standard while giving the economy the flexibility it needed. Opponents raised concerns about inflation, about government control, about the proper relationship between Washington and the regional reserve banks. The debate went on for weeks, through hundreds of amendments, dozens of votes on particular provisions. Gradually the bill took its final form. There would be 12 Federal Reserve districts, with a Federal Reserve Bank in a major city in each district. These reserve banks would be corporations owned by the member banks in their districts, but they would operate under the supervision and regulation of a Federal Reserve Board in Washington. The board would consist of 7 members, appointed by the President with Senate confirmation, serving staggered terms to ensure continuity and independence. Member banks would be required to keep a portion of their reserves on deposit with their regional Federal Reserve Bank. In return, they would have access to the discount window, the ability to borrow from the Fed when they needed temporary liquidity. The interest rate for this borrowing, the discount rate, would be set by each regional Fed subject to approval by the board in Washington. The Federal Reserve would issue a new currency, Federal Reserve notes, which would gradually replace the diverse bank notes then in circulation. These notes would be backed by gold and commercial paper, ensuring their value while allowing the supply to expand and contract with economic needs. The notes would be obligations of the United States, bearing the government's promise to redeem them, removing the uncertainty that had characterized earlier bank notes. The House passed the bill in September. The Senate took longer, with extended debate through the autumn. Some senators wanted to strengthen government control further, others wanted to preserve more banker influence. The Banking Committee chairman, Robert Owen of Oklahoma, worked to find compromises that could command majority support. As autumn turned to winter, as Congress moved toward adjournment for the holidays, the pressure built to complete action on the banking bill. Wilson wanted it finished, wanted to sign this major reform before the year ended. Glass and Owen worked to resolve the remaining disagreements, to bring hesitant senators on board, to assemble the votes needed for passage. On December 19, 1913, the Senate voted. The bill passed, 64 to 34, with support from both parties but also opposition from both. It was sent to a conference committee to resolve minor differences with the House version. The conference worked quickly. By December 22nd, the differences had been reconciled. Both houses needed to vote again on the final version. The House voted first, passing it easily. The Senate scheduled its final vote for December 23rd. It was almost Christmas. Many members of Congress had already left Washington for the holidays, but enough remained to conduct business. On the evening of December 23rd, with a winter rain falling outside, the Senate cast its final vote. The bill passed. It was sent to the White House that same evening. Woodrow Wilson was waiting, ready to sign this legislation that he had come to understand as essential for American financial stability. He had learned much in the months since taking office, had evolved from knowing little about banking to having firm opinions about what reform should accomplish. The bill on his desk was not perfect. It satisfied no one completely, but it was workable, a genuine compromise that addressed real problems. Wilson signed the Federal Reserve Act into law in the early evening of December 23, 1913. There was no grand ceremony, no crowds gathered to witness history. Just the President, a few advisers, the scratch of pen on paper, and a law that would reshape American finance. The Act established a Federal Reserve System, not a bank, but a system, a network of institutions designed to work together. It was a peculiarly American creation, neither fully government nor fully private, neither fully centralized nor fully dispersed. It reflected American ambivalence about concentrated power, American federalism, with its preference for regional autonomy, American pragmatism seeking solutions that might actually work rather than ideological purity. With the law signed, the practical work could begin. The Federal Reserve Organization Committee, consisting of the Secretary of the Treasury, the Secretary of Agriculture, and the Comptroller of the Currency, faced the task of dividing the country into 12 districts and selecting a city in each district to host a Federal Reserve Bank. This was no simple matter. Cities competed fiercely for the honor and economic benefit of hosting a Fed. Dozens of cities submitted applications, each arguing why it should be chosen. The committee traveled the country through the early months of 1914, holding hearings, examining economic data, listening to arguments. Some choices were obvious. New York, the nation's financial center, would certainly have a Federal Reserve Bank. Chicago, the commercial hub of the Midwest, was equally certain. But what about the South? Should Atlanta be chosen, or New Orleans, or Dallas? What about the West? San Francisco seemed likely, but should there be another Western Fed as well? The final selections, announced in April of 1914, reflected both economic logic and political compromise. The 12 cities chosen were Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. Each would host a Federal Reserve Bank serving its district, working within the framework that Congress had created. Buildings needed to be acquired or constructed. Staff needed to be hired. Directors needed to be elected by member banks and appointed by the Federal Reserve Board. Operating procedures needed to be developed. The discount rate needed to be set. Reserve requirements needed to be implemented. Thousands of details required attention. The process took months. The Federal Reserve Banks officially opened for business on November 16, 1914. By that time, the world had changed dramatically. War had begun in Europe in August, plunging the major powers into a conflict that would reshape the 20th century. The United States remained neutral, but the war would affect American finance profoundly, creating challenges the new Federal Reserve would need to address almost immediately. But on that November day in 1914, as the 12 Federal Reserve Banks opened their doors for the first time, the focus was simply on beginning operations, on learning to perform the functions that Congress had assigned. The staff were new, the procedures untested, the institution itself barely formed. No one knew exactly how well it would work, whether the elaborate structure of regional banks and central board would function smoothly, whether the discount window would provide the stability that reformers had promised. The Federal Reserve had been created to prevent financial panics, to provide an elastic currency, to serve as a lender of last resort. Whether it would succeed in these missions remained to be seen. The institution existed now, established by law, funded, staffed, operational. But it was unproven, untested, a creation of theory and compromise that would now face the realities of American and global finance. The quiet beginning, in those final weeks of 1914, gave little hint of the enormous role this new institution would come to play. The Federal Reserve was simply there, one more government agency among many, one more part of the financial infrastructure. The real test would come with time, with crises, with the need to make difficult decisions under pressure. That test lay ahead, in the years and decades to come, as the Federal Reserve grew from a theoretical solution to practical problems into an institution that would touch every aspect of American economic life. The Federal Reserve Banks that opened in November of 1914 were, in truth, works in progress. They occupied temporary quarters in most cities, rented space in office buildings while more permanent homes could be arranged. The staff were learning their jobs as they performed them, developing procedures that had existed only in theory until now. The member banks were adjusting to the new requirements, to keeping reserves with the Fed, to understanding how the discount window worked and when they might use it. In New York, the most important of the 12 Federal Reserve Banks by virtue of the city's role in American and international finance, leadership fell to a man who had been part of the Jekyll Island gathering 4 years earlier. Benjamin Strong was 39 years old when he became the first president of the Federal Reserve Bank of New York. He had worked in banking all his adult life, starting as a clerk and rising through ability and connections to senior positions at Bankers Trust. Strong was energetic, intellectually curious, and ambitious for the institution he now led. Strong understood that the New York Fed would inevitably be first among equals in the Federal Reserve System. New York was where the major banks had their headquarters, where the stock market operated, where international transactions were settled, where financial decisions of national importance were made daily. The New York Fed would handle the largest volume of operations, hold the most reserves, have the closest relationships with the most important financial institutions. This gave it influence beyond what the formal structure of the system might suggest. But Strong also understood that the system was meant to be decentralized, that the other 11 Federal Reserve banks had their own responsibilities and prerogatives, that the board in Washington was supposed to provide coordination and oversight. The tension between New York's natural prominence and the system's federal structure would persist throughout the Fed's history, sometimes creative, sometimes difficult, always present. The new institution barely had time to establish itself before the world changed around it. The war that had begun in Europe in August of 1914, which Americans had initially viewed as a distant conflict unlikely to affect them directly, grew into a massive struggle consuming the energies and resources of all the major European powers. Britain and France fought Germany and Austria-Hungary in battles of unprecedented scale and horror, with millions of men dying in trenches that stretched across Belgium and France. The United States remained neutral through 1914, 1915, and 1916. But American neutrality was complicated. American banks lent money to the Allied powers, Britain and France, helping them purchase war materials. American factories produced guns, shells, uniforms, all the supplies that modern war demanded. American trade with the Allies expanded enormously, while trade with Germany and Austria-Hungary, cut off by British naval blockades, essentially ceased. This created awkward questions for the Federal Reserve. Should it accommodate the expansion of credit that war trade required? Should it worry about inflation driven by war demand? Should it consider the international implications of American financial policy when Britain and France were struggling to maintain their currencies and their ability to pay for the war? Before these questions could be fully answered, America was drawn into the war itself. German submarine warfare attacking ships carrying American passengers and cargo created increasing friction. In April of 1917, President Wilson asked Congress for a declaration of war, and Congress agreed. The United States became a combatant, joining Britain and France against Germany. The war transformed the Federal Reserve's role almost immediately. The government needed to borrow enormous sums to finance American military mobilization. Millions of men would be drafted, equipped, trained, and transported to Europe. Ships, weapons, ammunition, food, all the material of modern war had to be produced and delivered. The cost would run into billions of dollars, sums far beyond what normal taxation could provide. The solution was war bonds, government securities sold to the public and to financial institutions, borrowing money that would be repaid with interest after the war. The Treasury Department organized Liberty loan drives, massive publicity campaigns encouraging Americans to buy bonds, to invest in victory, to support the troops. Banks were enlisted to sell the bonds, to lend to customers who wanted to buy bonds, to accept bonds as collateral for other loans. The Federal Reserve's role was to ensure that this borrowing didn't exhaust the banking system's capacity to lend. The Fed would lend to banks, allowing them to lend to bond purchasers, creating the credit necessary to absorb billions of dollars in government debt. The discount rate was kept low to encourage this lending, making it inexpensive for banks to borrow from the Fed and thus inexpensive for their customers to borrow from the banks to buy bonds. This was the Fed's first major test, though not quite the test it had been designed for. Instead of preventing a financial panic, the Fed was helping finance a war. Instead of maintaining the purchasing power of the currency, it was accommodating an expansion of credit that would inevitably be inflationary. The gold standard, which was supposed to constrain monetary policy, was effectively suspended, with gold exports restricted to prevent the metal from flowing abroad and draining reserves. Benjamin Strong coordinated much of this effort, working with the Treasury, with the other Federal Reserve banks, with major commercial banks. The New York Fed, because of its relationships with the largest banks and its experience with international finance, took the lead in operations that affected the entire system. Strong travelled to Washington frequently, consulting with the Federal Reserve Board, ensuring that policy was coordinated across the 12 districts. The war ended in November of 1918 with Germany's surrender. The immediate crisis passed, but its effects lingered. Prices had risen sharply during the war, driven by heavy government spending and expanded bank credit. The money supply had grown substantially. Soldiers returning from Europe needed jobs, housing, a return to civilian life. European countries, devastated by 4 years of war, needed to rebuild. The Federal Reserve now faced a different challenge: how to transition from war finance to peacetime stability. Should the discount rate be raised to restrain credit and control inflation? Or should it be kept low to ease the transition to a peacetime economy, to avoid a recession as war production wound down? There was no obvious answer, no clear precedent to guide the decision. The Fed chose restraint. Through 1919 and into 1920, the discount rate was raised sharply in some cases. Credit tightened. Borrowing became more expensive. The expansion of the war years reversed. The economy, which had been running hot, overheated, prices rising rapidly, now began to contract. The recession that followed, running from early 1920 into 1921, was sharp and painful. Unemployment rose to levels not seen since the Depression of the 1890s. Prices fell rapidly, deflation replacing the inflation of the war years. Businesses failed, especially in agriculture, where farmers had expanded production during the war and now found themselves with too much capacity and falling prices. Banks in agricultural regions faced losses as farmer borrowers couldn't repay their loans. This was the first major peacetime test of the Federal Reserve's ability to manage the economy. By some measures, it was not successful. The recession was severe, the adjustment painful. But by other measures, perhaps it was necessary. The inflation of the war years had to be wrung out of the economy. Prices had to adjust to peacetime realities. The alternative might have been continued inflation, eroding the value of money, creating distortions that would cause problems later. The Fed learned from this experience, though exactly what lessons it drew would be debated for decades. One lesson seemed to be that monetary policy was powerful, that changes in the discount rate could have large effects on the economy, that the Fed needed to use its tools carefully, watching for unintended consequences. another lesson emerged almost accidentally. During the war, the Federal Reserve banks had begun buying government securities in the open market, purchasing treasury bonds not from the treasury itself, but from banks and other investors who already held them. This had been done primarily to support the market for Liberty bonds, to ensure that investors could sell their bonds if they needed cash, maintaining confidence in the government's credit. But someone noticed that when the Fed bought government securities in the open market, bank reserves increased. The Fed paid for the securities by crediting the selling bank's account at the Fed, creating new reserves. When the Fed sold securities, it debited the bank's account, reducing reserves. And since banks could lend based on their reserves, increasing reserves meant more potential lending, while reducing reserves meant less. This was open market operations, a new tool of monetary policy that hadn't been explicitly contemplated when the Federal Reserve Act was written. It was more flexible than the discount rate in some ways. The Fed could buy or sell securities daily, in whatever quantities seemed appropriate, fine-tuning the level of bank reserves and thus the availability of credit. The discount rate, by contrast, was a posted rate that banks could choose to use or not, making its effect somewhat less predictable. Through the 1920s, the Federal Reserve, and particularly Benjamin Strong at the New York Fed, developed the use of open market operations into a sophisticated tool. The Fed would buy securities when it wanted to ease credit conditions, injecting reserves into the banking system. It would sell securities when it wanted to tighten credit, withdrawing reserves. Combined with adjustments to the discount rate, these operations gave the Fed considerable influence over financial conditions. The 1920s were, for the most part, a period of prosperity and relative stability. The sharp recession of 1920 and 21 was followed by recovery, and then sustained growth. New industries emerged: automobiles, radio, motion pictures, electric appliances. Productivity increased as factories adopted mass production techniques. Living standards rose, especially in cities and for middle-class Americans. The Federal Reserve took some credit for this stability, believing that its policies were helping to smooth out the business cycle, preventing the kind of sharp fluctuations that had characterized earlier periods. Benjamin Strong, in particular, developed a confident belief that central banking, done skillfully, could maintain prosperity while preventing both inflation and financial panics. Strong also developed close relationships with European central bankers, particularly Montague Norman, the governor of the Bank of England. Norman and Strong met regularly, corresponded frequently, and coordinated their policies to the extent possible. Both men believed in the gold standard as the foundation of sound money, but both also recognized that the gold standard needed to be managed, that central banks had to cooperate to make the system work. The European economies were struggling in the 1920s, burdened by war debts, reparations payments demanded from Germany, currencies that had lost value during the war. Britain had returned to the gold standard at the pre-war parity, meaning the pound was valued at the same gold content it had had before the war, even though prices in Britain had risen substantially. This made British goods expensive in international markets, creating persistent unemployment and economic stagnation. Strong sympathized with Norman's difficulties and tried to help. The New York Fed kept interest rates relatively low, making it less attractive for gold to flow from Britain to the United States, helping Britain maintain its gold reserves and thus its ability to stay on the gold standard. This was informal coordination, not required by any law or treaty, but motivated by Strong's belief that international financial stability served American interests. Not everyone agreed with this approach. Some of the other Federal Reserve banks, particularly Chicago, believed that the Fed should focus on domestic conditions, not worry about European problems. Some members of the Federal Reserve Board in Washington resented Strong's dominant role, his tendency to act first and consult later, his close relationship with Norman and other foreign central bankers. But Strong had the confidence of the financial community, the respect of his peers at the other reserve banks, and the credibility that came from the New York Fed's importance in the system. His leadership was informal, not based on formal authority, but it was real. When Strong expressed a view about monetary policy, people listened. When he proposed a course of action, others usually went along. Through the middle 1920s, the economy hummed along, prosperity spreading, stock prices rising steadily, credit expanding but not dangerously. There were small problems, concerns, bubbles that formed and popped without causing major disruption. Florida experienced a land boom in 1925, with real estate prices in Miami and other areas soaring as speculators bought land expecting to sell it for higher prices. The boom collapsed in 1926, leaving some investors ruined but not affecting the broader economy significantly. The stock market became increasingly active through the late 20s. More Americans were investing in stocks, often with borrowed money. Brokers would lend to customers, who would use the borrowed funds to buy more stock than they could afford with their own money. This leverage magnified gains when stocks rose, but it would also magnify losses if stocks fell. Some observers worried about this speculation, about stock prices that seemed to be rising faster than company earnings justified, about the amount of credit flowing into the market. The Fed discussed the issue, debated whether it should try to restrain stock market speculation, considered raising interest rates to make borrowing more expensive and thus reduce speculative buying. But raising interest rates to restrain stock market speculation would also affect the broader economy, making all borrowing more expensive, potentially slowing business investment and employment. And there was uncertainty about whether the Fed even should try to manage stock prices. Its mandate was to maintain stable prices and financial stability, not to judge whether stock valuations were appropriate. If investors wanted to speculate, if they were willing to take risks with their own money or with borrowed money whose terms they understood, should the Fed intervene? These debates continued through 1927 and 1928 without reaching clear resolution. The economy seemed healthy, unemployment was low, prices were stable, stock prices were high, but perhaps they were justified by genuine improvements in productivity and profits. Perhaps this time really was different, a new era of sustained prosperity made possible by technological progress and skillful economic management. Benjamin Strong might have provided clearer leadership, might have steered the Fed toward a more decisive policy. But Strong was ill. He had suffered from tuberculosis for years, traveling to Colorado and other locations seeking treatment and rest. The disease was slowly winning. In October of 1928, Strong died at his home in New York. He was 55 years old, having served as president of the New York Fed for 14 years, having shaped the institution during its formative period. Strong's death removed the Fed's most influential and experienced leader just as difficult questions were arising about speculation and the appropriate course of monetary policy. The New York Fed chose George Harrison, Strong's deputy, to succeed him. Harrison was capable and knowledgeable, but he lacked Strong's force of personality, his deep relationships with other central bankers, his credibility with both the financial community and the Federal Reserve Board. The leadership vacuum created by Strong's death would matter more than anyone realized at the time. The Federal Reserve System, still only 14 years old, still learning how to use its powers effectively, would soon face its greatest test. The prosperity of the 1920s, the confidence that skillful central banking could maintain stability, the belief that financial panics were problems of the past, all of this would be challenged in ways that no one in 1928 could quite imagine. But in the final months of 1928, as the year drew to a close, the economy still seemed strong. Stock prices continued to rise. Business was good. Employment remained high. The Federal Reserve had established itself as a permanent part of American finance, no longer a controversial experiment, but an accepted institution. Whatever problems might arise, Americans could be confident that their central bank, with its regional structure, its experienced staff, its proven tools, would be able to maintain stability. That confidence, like so much confidence, would soon be tested in ways that would reveal both the possibilities and the limits of what a central bank could accomplish. The year 1929 began much as the previous years had, with optimism, with prosperity, with a sense that the good times would continue indefinitely. Stock prices rose through the winter and spring, reaching new heights. Trading volume on the New York Stock Exchange set records. More Americans than ever before owned shares in corporations, participated in the market, watched stock prices in newspapers, discussed investments with friends and colleagues. There were warnings, quiet voices suggesting caution. Some analysts noted that stock prices had risen much faster than corporate earnings, that valuation seemed stretched, that speculation had become excessive. The Federal Reserve itself was concerned, debating through the spring and summer whether to tighten credit to restrain the market. But the economy seemed fundamentally sound. Production was strong, unemployment was low, business confidence remained high. Through the summer of 1929, stock prices continued upward, though with increasing volatility. Sharp one-day declines were followed by recoveries. The market would drop, then rally, then drop again, creating a sense of unease that began to spread even among optimistic investors. By September, the upward momentum had stalled. Prices drifted sideways, unable to reach new highs but not falling dramatically either. October brought change. On Thursday, October 24th, heavy selling began. Prices fell sharply in the morning, recovered somewhat by afternoon, but closed well below the previous day's levels. The volume of trading was enormous, overwhelming the capacity of clerks to process all the transactions. By the time the exchange closed, no one knew exactly where prices stood because the tape recording trades was running hours behind. The following Monday, October 28th, selling resumed with greater intensity. There seemed to be no particular news driving the decline, just a general sense that prices had risen too far, that it was time to take profits or cut losses. On Tuesday, October 29th, the selling became indiscriminate. Prices fell across the board, blue-chip stocks and speculative shares alike, in the heaviest trading day in the market's history. 16 million shares changed hands, more than 3 times the normal daily volume. The crash, as it came to be called, was unsettling but not immediately catastrophic. Stock prices had fallen sharply, certainly, wiping out paper gains accumulated over previous years. Investors who had bought on margin using borrowed money found themselves owing more than their shares were now worth. But the economy itself still seemed solid. Production continued, employment remained relatively high, business went on. What made October of 1929 the beginning of the Great Depression was not the stock market crash itself, but what followed. The slow, grinding contraction of the economy that unfolded over the next 3.5 years. And at the centre of that contraction, though it would take years for people to understand this fully, was the Federal Reserve's failure to act, to provide the liquidity and stability that it had been created to provide. The immediate problem was not stocks, but banks. Through the 1920s, particularly in agricultural regions, many small banks had been struggling. Farmers, burdened by debts taken on during the war years when crop prices were high, could not repay loans when prices fell. Banks that had lent to these farmers faced losses. Some failed, their depositors losing their savings. But these failures were isolated, contained, not threatening to the broader financial system. After the stock market crash, bank failures began to accelerate. In November and December of 1929, hundreds of banks closed, unable to meet depositor withdrawals or cover losses on loans that had gone bad. Through 1930, the pace quickened. More than 1,000 banks failed that year, concentrated in the South and Midwest, but spreading to other regions. When a bank failed, its depositors lost their money. There was no deposit insurance, no government guarantee that savings would be protected. If a bank couldn't pay, depositors simply absorbed the loss. This created a vicious cycle. When people heard that a bank had failed, they worried about their own banks, wondered if their savings were safe. Some would rush to withdraw their money just to be careful, just to avoid the risk of loss. But banks don't keep all deposits in cash in their vaults. They lend most of the money out to businesses and homeowners and farmers. The loans are good assets generally, likely to be repaid over time, but they're not liquid. They can't be called in immediately to satisfy depositors who want their money now. A bank facing a run, even a fundamentally sound bank with good loans, can find itself unable to meet withdrawals, forced to close or suspend operations. This was exactly the situation the Federal Reserve had been created to prevent. Banks facing temporary liquidity problems were supposed to be able to borrow from their regional Federal Reserve Bank, pledging their good loans as collateral, receiving cash to meet withdrawals. The discount window was meant to be the solution to bank runs, the mechanism that would allow sound banks to survive temporary panics. But the Federal Reserve, in those crucial years of 1930, 1931 and 1932, did not fulfill this role adequately. The reasons were complex, rooted in misunderstanding, in organizational problems, in a failure to grasp the full scope of what was happening. Some regional Federal Reserve banks were reluctant to lend, worried about taking on assets from troubled banks, concerned about their own reserve positions. The Federal Reserve Board in Washington provided little leadership, offering no clear guidance about how aggressively the regional bank should lend. The discount rate, instead of being lowered to encourage borrowing, was actually raised in some districts, making it more expensive for banks to seek Fed assistance. The leadership vacuum left by Benjamin Strong's death 2 years earlier was painfully apparent. Strong had understood the Fed's role as lender of last resort, had coordinated policy across the 12 regional banks, had provided intellectual leadership and operational direction. Without him, the system operated in a more decentralized, less coordinated manner. Regional bank presidents made decisions based on their own assessment of conditions in their districts, not always considering the national implications. Perhaps more fundamentally, there was a misunderstanding about what the Fed should do in a deflationary environment. Prices were falling, the opposite of inflation. Some Fed officials believed this was actually healthy, that the high prices of the 1920s had been artificial, that correction was necessary and proper. They viewed bank failures as a kind of natural selection, weeding out weak institutions, leaving the financial system stronger. This view, which seems harsh in retrospect, reflected a philosophy common at the time, the idea that economic downturns were self-correcting, that markets would find their own equilibrium if left alone, that government intervention would only delay necessary adjustments. The Fed did not see itself as responsible for preventing bank failures or supporting the economy. It saw its role more narrowly as maintaining the gold standard and ensuring that the currency remained sound. The gold standard, which had been suspended during the war but restored in the 1920s, constrained what the Fed could do. Under gold standard rules, the money supply had to be backed by gold reserves. If gold flowed out of the country, as it sometimes did when foreign investors lost confidence in American assets, the money supply had to contract correspondingly. This meant the Fed couldn't simply expand credit freely to support the banking system, at least not without risking a drain of gold that would force a currency devaluation. Through 1931, the situation worsened. In Europe, financial crises struck Austria and Germany, with major banks failing and governments struggling to maintain their currencies. Britain, which had returned to the gold standard in the 1920s at great cost, abandoned it in September of 1931, allowing the pound to float rather than maintaining a fixed gold value. This shook confidence in the entire international financial system. In the United States, bank failures continued accelerating. Through 1931, more than 2,000 banks closed. Depositors who still had money in banks began withdrawing it, not necessarily because they distrusted their particular bank, but because they wanted the safety of holding cash, of having money under their control rather than at risk in an institution that might fail. This mass withdrawal of deposits from the banking system had devastating effects on the money supply. Banks create money when they lend. When you deposit $1,000 in a bank and the bank lends $900 to someone else, that $900 is spent and typically deposited in another bank, which lends most of it to someone else, and so on. Through this process, the initial $1,000 supports several $1,000s of deposits across the banking system. This is the money multiplier effect, the way fractional reserve banking expands the money supply, but the process works in reverse as well. When deposits are withdrawn, when banks close, when surviving banks become cautious and stop lending, the money multiplier runs backward, the money supply contracts, credit becomes scarce, the economy slows, and this is exactly what happened through 1930, 1931, and 1932. The money supply fell by roughly 1/3, one of the largest monetary contractions in American history. With less money circulating, prices fell further. Deflation became severe, with prices declining by about 1/4 from their 1929 levels. This deflation made debts harder to repay, since debtors had to repay loans in dollars that were now worth more than the dollars they had borrowed. Farmers, businesses, homeowners, anyone with debt found themselves squeezed, unable to earn enough in an economy with falling prices to meet fixed debt obligations. Unemployment rose sharply. By 1932, roughly 1/4 of the American workforce was unemployed, unable to find work despite being willing and able. Factories closed, farms were foreclosed, families lost their homes. The prosperity of the 1920s seemed like a distant memory, replaced by hardship and uncertainty. The Federal Reserve, through all of this, remained largely passive. It did not dramatically lower interest rates. It did not aggressively purchase government securities to inject money into the banking system. It did not forcefully encourage banks to borrow from the discount window. The regional Federal Reserve banks continued their operations, processing checks, holding reserves, performing their routine functions. But they did not act as the aggressive lender of last resort that the situation required. Years later, economists studying this period would identify the Fed's inaction as a crucial failure. Milton Friedman and Anna Schwartz, in their influential study of American monetary history published in 1963, argued that the Great Depression was largely a monetary phenomenon, that the contraction of the money supply turned what might have been an ordinary recession into a catastrophic depression. They pointed to the Fed's failure to prevent bank failures, its failure to expand credit when the economy desperately needed liquidity, its adherence to the gold standard even when that adherence was deepening the crisis. But this understanding came with hindsight, with decades of additional experience and economic analysis. In the early 1930s, the Fed's officials did not understand that they were allowing, perhaps even causing, a monetary disaster. They thought they were being prudent, responsible, maintaining sound money principles. They did not yet grasp the full scope of a central bank's responsibility, the active role it needed to play in severe downturns. By 1933, the banking system was in crisis across the country. Runs accelerated through February, with depositors lining up outside banks, demanding their money, forcing closures even of institutions that were fundamentally sound. State governors began declaring bank holidays. Temporary closures meant to stem the panic, but these holidays only increased anxiety in other states, leading to more runs. Franklin Delano Roosevelt was inaugurated as president on March 4, 1933. The country he inherited was in the depths of the Depression, the banking system on the verge of complete collapse. Roosevelt understood that immediate action was necessary, that the slow unraveling could not be allowed to continue. On March 6th, his second full day in office, Roosevelt declared a national bank holiday, closing all banks throughout the country for 4 days. It was an extraordinary use of presidential power, a clear signal that the new administration intended to act decisively. While the banks were closed, Roosevelt worked with Congress to pass emergency legislation. The Emergency Banking Act, passed by Congress on March 9th and signed immediately by Roosevelt, gave the government tools to stabilize the banking system. It allowed the Treasury to examine banks, determining which were sound enough to reopen and which needed reorganization or closure. It permitted the Federal Reserve to issue more currency, backed not just by gold but by bank assets, allowing the money supply to expand. It gave the president powers to regulate international gold transactions, beginning the process of moving away from the gold standard. banks began reopening on March 13th, with those deemed sound allowed to resume operations. Roosevelt gave a radio address, one of his famous fireside chats, explaining what had been done and urging Americans to have confidence in the reopened banks. The response was remarkable. Deposits began flowing back into banks as people brought their hoarded cash back into the system. The immediate panic subsided, but the underlying problems remained. The economy was still deeply depressed, unemployment still massive, thousands of banks still closed. Additional reforms were needed, structural changes that would prevent future crises and restore confidence in the financial system. Congress passed the Glass-Steagall Act in June of 1933. This legislation separated commercial banking from investment banking, preventing banks that took deposits from also underwriting securities. The idea was to protect depositors' funds from the risks of speculative investment activities. The Act also created the Federal Deposit Insurance Corporation, which would guarantee bank deposits up to a certain amount, ensuring that depositors wouldn't lose their savings if a bank failed. This would remove the incentive for runs, since depositors would know their money was safe regardless of the bank's condition. For the Federal Reserve, the most significant change came with the Banking Act of 1935. This legislation reorganized the Fed, centralizing power in the Board of Governors in Washington, reducing the autonomy of the regional Federal Reserve banks. The renamed Board of Governors would have 7 members, appointed by the President to 14-year terms, giving them independence from short-term political pressures, but also ensuring accountability to elected officials. The Act also created the Federal Open Market Committee, or FOMC, which would coordinate open market operations across the entire system. Previously, each regional Fed had conducted its own open market operations, buying and selling government securities based on its own judgment. Now these operations would be centralized, with the FOMC making decisions for the system as a whole. The FOMC would include the 7 governors and 5 of the 12 regional Fed presidents, rotating so that all regions had input but with the board maintaining control. These reforms reflected a judgment that the Fed's decentralized structure had contributed to its failures during the Depression. The regional banks, operating independently, had not coordinated their responses, had not understood the national scope of the crisis, had not acted with the force and speed that the situation required. Centralizing authority would, it was hoped, allow for more decisive action in future crises. The reforms also reflected a shift in power from New York to Washington, from the financial community to the government. The Fed would remain a peculiar hybrid, neither fully private nor fully public, but the balance had shifted toward public control and accountability. The bankers who owned stock in the regional Feds would still elect some directors, but the real power would reside with the presidentially appointed Board of Governors. The Federal Reserve emerged from the Depression chastened, its reputation damaged, its independence questioned. It had failed in its most important test, had allowed the banking system to collapse, had presided over a monetary contraction that deepened and prolonged the economic crisis. The confidence of the 1920s, the belief that skillful central banking could maintain perpetual prosperity, had been shattered. But the institution survived, reformed and reorganized, still performing the basic functions for which it had been created. The discount window remained, though its use would be guided by clearer policies. Open market operations continued, now coordinated centrally. The 12 regional Federal Reserve banks still operated, still served their districts, still provided a federal structure within the system. What changed, perhaps most fundamentally, was the understanding of what a central bank should do. The passive approach, waiting for problems to resolve themselves, believing that market forces alone would restore equilibrium, had been tried and found wanting. The Fed would need to be more active, more willing to intervene, more aggressive in providing liquidity during crises. It would need to consider its effects on the broader economy, not just on banks and the gold standard. It would need to learn new lessons, develop new tools, evolve with changing economic circumstances. The Great Depression, as terrible as it was, became a kind of education, though one purchased at enormous cost. The Fed learned what not to do, learned the consequences of inaction, learned that sometimes aggressive intervention is necessary, even when it seems to violate traditional principles. These lessons would shape the institution for decades to come, informing how it responded to later crises, how it thought about its role and responsibilities. But there was little time to absorb these lessons fully before new challenges arose. The world was moving toward another war, one that would dwarf even the Great War in its scope and destructiveness. And that war would create yet another test for the Federal Reserve, another set of circumstances requiring adaptation and response. The war that came in the 1940s was different from the Great War of 1914 to 1918, though it grew from some of the same unresolved tensions. It began in Europe in September of 1939 when Germany invaded Poland, and it spread across continents and oceans until most of the world was involved in some way. The United States tried to remain neutral at first, as it had done in the earlier war, but events pulled the country toward involvement. On December 7th, 1941, Japan attacked the American naval base at Pearl Harbor in Hawaii. Congress declared war the next day. Within a week, the United States was at war not only with Japan but with Germany and Italy as well, joining Britain and the Soviet Union in fighting the Axis powers. The conflict would last nearly 4 years, consuming resources on a scale that dwarfed even the Great War. For the Federal Reserve, the war brought a return to the role it had played in 1917 and 1918, financing government borrowing. But this time the amounts were vastly larger, the duration longer, the Fed's subordination to the Treasury more complete. The war would cost hundreds of billions of dollars, sums almost impossible to comprehend at the time. This money had to be borrowed, and the borrowing had to be done at interest rates that wouldn't cripple the government's finances. The Treasury Department took the lead in managing war finance. It issued bonds in different maturities, from short-term bills to long-term bonds, selling them to banks, insurance companies, other financial institutions, and the general public. The Federal Reserve's role was to ensure that these bonds could be sold, that there would always be buyers, that interest rates would remain low enough to keep the government's borrowing costs manageable. To accomplish this, the Fed agreed to support the government bond market. If bond prices fell, meaning interest rates rose, the Fed would step in and buy bonds, supporting their price and thus keeping rates down. This commitment essentially meant that the Fed gave up control over interest rates and monetary policy. The Treasury set the rates it wanted to pay on bonds, and the Fed accommodated that preference, creating whatever money was necessary to keep rates at those levels. The wartime arrangement was, in a sense, unavoidable. The country was fighting for its survival, mobilizing its full economic capacity for military production. Financing had to be subordinated to winning the war. Questions about Fed independence, about the proper role of monetary policy, about the long-term consequences of keeping rates artificially low, these were secondary concerns compared to the immediate need to fund the war effort. Interest rates during the war were kept very low, below 3% even for long-term bonds. This made borrowing cheap for the government, allowing it to finance the war without accumulating crushing debt burdens. But it also meant that money creation accelerated, that the money supply expanded substantially, that inflationary pressures built up even though price controls during the war suppressed their visible effects. The war ended in August of 1945 with Japan's surrender following Germany's surrender 3 months earlier. Victory brought relief, celebration, and the enormous task of demobilizing millions of soldiers, converting war industries back to peacetime production, reintegrating veterans into civilian life. But it did not bring an end to the Federal Reserve's subordination to the Treasury. The Treasury wanted to continue the wartime policy of low interest rates. The government still had enormous debts from the war, and Treasury officials wanted to keep borrowing costs down. They argued that higher interest rates would increase the burden on taxpayers, that supporting the bond market was necessary for financial stability, that any change in policy should wait until the economy had fully adjusted to peacetime conditions. The Federal Reserve's leadership was increasingly uncomfortable with this arrangement. The war was over. The emergency that had justified subordinating monetary policy to fiscal needs had passed. The economy was growing, recovering from the Depression years, adjusting to peacetime. Keeping interest rates artificially low was creating inflation as wartime price controls were lifted and the accumulated monetary expansion began to affect prices. But the Fed lacked the power, or perhaps the will, to break free from Treasury control. The commitment to support government bond prices remained in place. When the Fed tried to raise rates even modestly, the Treasury objected, and the Fed backed down. The institution that had been created to be independent, to make monetary policy decisions based on economic conditions rather than political pressures, found itself unable to exercise that independence. Tensions between the Fed and the Treasury simmered through the late 1940s. Inflation was becoming a problem, with prices rising at rates that eroded the value of savings and created economic distortions. The Fed wanted to tighten policy, to raise interest rates and slow the growth of money and credit. The Treasury insisted that rates remain low, that bond prices be supported, that the Fed continue its wartime accommodation. The situation came to a head with the outbreak of the Korean War in June of 1950. North Korea, backed by the Soviet Union and Communist China, invaded South Korea. The United States, leading a United Nations coalition, came to South Korea's defense. The war created new demands for military spending, new borrowing by the government, new pressures on the economy. The Treasury wanted the Fed to continue, even strengthen, its support of the bond market. With a war on, with military spending rising, it seemed obvious to Treasury officials that the Fed should help keep borrowing costs down, just as it had done during World War II. But Fed officials believed this would create dangerous inflation, that the economy was already running too hot, that continuing to create money to support artificially low interest rates would lead to economic instability. The dispute became public in January of 1951. President Truman called Fed officials to the White House and announced after a meeting that the Fed had agreed to continue supporting Treasury bonds at existing rates. The Fed's chairman, Thomas McCabe, was stunned. No such agreement had been reached. The Fed had listened to the president's views but had made no commitment. Truman's announcement was essentially an attempt to pressure the Fed into compliance by publicly claiming its agreement. The Fed pushed back. In an unusual public statement, the Board of Governors made clear that no agreement had been reached, that the Fed retained its independence, that monetary policy could not simply be dictated by the Treasury or the White House. This was unprecedented, an open break between the Fed and the administration, a public assertion of independence at a time when the country was at war. Negotiations began in earnest, with the goal of finding some compromise that would give the Treasury assurance that bond rates wouldn't skyrocket, while giving the Fed freedom to conduct monetary policy as it saw fit. The talks were difficult, with strong personalities and conflicting institutional interests. The Treasury was represented by Secretary John Snyder, who believed firmly that the Fed should serve the government's borrowing needs. The Fed was now led by William McChesney Martin, who had become chairman in April of 1951, replacing McCabe. Martin was 44 years old, younger than most people who reach such high positions. He had worked at the New York Stock Exchange, serving as its president in his early 30s. During World War II, he had worked at the Treasury Department, helping to organize bond sales. After the war, he had served at the Export-Import Bank before being appointed to the Federal Reserve Board in 1950. His background gave him credibility with both the financial community and the government. Martin brought a clear philosophy to the chairmanship. He believed deeply in the Fed's independence, in the principle that monetary policy should be made by experts, insulated from short-term political pressures. He understood the Treasury's concerns about borrowing costs, but he believed that the Fed's responsibility was to the long-term health of the economy, not to making life easy for the government's finance officers. The negotiations between the Fed and the Treasury stretched through February of 1951. Martin met repeatedly with Snyder, with other Treasury officials, with presidential advisors. The discussions were sometimes heated, with fundamental disagreements about the Fed's proper role, about whether a central bank should be subordinate to fiscal authority or independent from it. Gradually, a framework emerged. The Fed would not abruptly abandon the bond market, would not allow interest rates to spike in ways that would disrupt government finance, but it would have the freedom to gradually adjust rates, to conduct monetary policy based on economic conditions, to act as an independent central bank rather than as an arm of the Treasury. The commitment to peg interest rates at specific levels would end, replaced by a more flexible approach that gave the Fed discretion while recognizing the government's legitimate interest in stable financial markets. On March 4, 1951, the Treasury and the Federal Reserve issued a joint announcement. It was brief, just a few sentences, stating that they had reached full accord with respect to debt management and monetary policies to be pursued in furthering their common purpose of assuring the successful financing of the government's requirements and, at the same time, minimizing monetization of the public debt. This statement, known as the Treasury-Fed Accord, was deliberately vague in its language, papering over disagreements rather than fully resolving them. But its significance was clear. The Federal Reserve had regained its independence. It would no longer automatically support government bond prices at fixed levels. It would conduct monetary policy as it saw fit, considering the needs of the overall economy, making decisions based on its assessment of what would promote price stability and sustainable growth. William McChesney Martin became the public face of this new independence. He served as Fed chairman for 19 years, from 1951 to 1970, the longest tenure in the position's history. During those years, he developed and articulated a clear vision of what the Fed should be and how it should operate. Martin often said that the Fed's job was to take away the punch bowl just as the party gets going. By this he meant that the Fed should tighten monetary policy, raise interest rates when the economy was booming and inflation threatened, even though this would be unpopular, even though politicians and the public wanted the good times to continue. The Fed had to be willing to make difficult decisions, to accept short-term criticism in service of long-term stability. This philosophy required independence. Politicians facing elections wanted low interest rates, wanted easy credit, wanted the economy to be strong regardless of whether that strength was sustainable. If the Fed simply did what politicians wanted, it would be too easy for too long, creating inflation and boom-bust cycles. Independence allowed the Fed to resist these pressures, to make decisions based on economic analysis rather than political expediency. But independence also required legitimacy. The Fed was not elected, its leaders not directly accountable to voters. For an unelected institution to have such enormous power, to make decisions that affected every American's economic life, it needed to operate with transparency, with clear explanations of its reasoning, with respect for its proper boundaries. Martin understood this, always explaining the Fed's decisions, testifying regularly before Congress, maintaining relationships with elected officials even while asserting independence from their immediate preferences. The Federal Reserve under Martin's leadership didn't seek conflict with the government. It tried to work cooperatively, to coordinate monetary and fiscal policy, when possible, to support the government's legitimate objectives. But it wouldn't simply subordinate itself, wouldn't give up its core function of maintaining price stability, even when that created tensions with the administration. Presidents sometimes chafed at this independence. Lyndon Johnson, who became president in 1963, wanted the Fed to keep rates low to support his domestic programs and the Vietnam War. He would call Martin to his Texas ranch, would pressure him directly, would make clear his displeasure when the Fed raised rates. But Martin, while respectful and accommodating when possible, would not compromise the Fed's independence or its mandate to control inflation. The 1950s and 60s, the years of Martin's chairmanship, were generally prosperous. The economy grew steadily, with only mild recessions. Inflation remained relatively low, at least compared to what would come later. Unemployment was generally moderate. The Fed seemed to be succeeding at its core mission, using monetary policy to promote stable growth, preventing the kind of boom-bust cycles that had characterized earlier periods. This success was built on the foundation established by the Accord of 1951. Without independence, the Fed couldn't have restrained credit when restraint was needed. Without the ability to raise rates despite political objections, it couldn't have maintained the price stability that allowed sustainable growth. The Accord didn't solve all problems, didn't make monetary policy easy, but it created the conditions under which the Fed could function as it was designed to function. The principle of central bank independence, established clearly in the United States by the Accord, spread internationally. Other countries recognized that central banks needed freedom from direct political control, that monetary policy made in response to short-term electoral pressures tended to create inflation and instability. The model that emerged, with appointed officials serving long terms, making decisions based on economic analysis, remained accountable through transparency and congressional oversight, but protected from day-to-day political interference, became standard practice in developed economies. But independence was not absolute, nor should it be. The Fed operated within a framework established by Congress, which had created it and could modify its mandate or structure. The Fed's leaders were appointed by elected officials and confirmed by the Senate. The Fed regularly reported to Congress, explained its decisions, faced questioning from representatives of the people. This democratic accountability, combined with operational independence, created a balance, not perfect, but workable, between expertise and democratic control. William McChesney. Martin's contribution was to demonstrate how this balance could work in practice, to show that the Fed could be both independent and responsible, both powerful and accountable. His 19 years as chairman established norms that would guide the institution long after he left office. The Fed would make its decisions based on its assessment of economic conditions, but it would explain those decisions publicly. It would resist political pressure when necessary, but it would remain respectful of elected officials and mindful of its limited mandate. When Martin retired in 1970, the Federal Reserve was a mature institution, confident in its role, experienced in using its tools, accepted as a permanent and necessary part of American economic governance. The struggles of the Depression, when the Fed had failed so badly, seemed like distant history. The subordination of the World War II years had been overcome. The Fed had found its place, established its independence, learned how to balance the demands of expertise and democracy. But new challenges were emerging even as Martin prepared to leave. Inflation, which had been relatively tame during most of his tenure, was beginning to accelerate. The economy was showing strains from the Vietnam War, from expanding government programs, from international monetary pressures. The next chapter in the Fed's history would test whether the independence won in 1951 could be maintained, whether the principles Martin had established would survive when economic conditions became more difficult, when the costs of fighting inflation became painfully apparent. The inflation that began to rise in the late 1960s was, at first, not particularly alarming. Prices had been stable for so long through the 1950s and early 60s that moderate increases seemed manageable, perhaps even normal in a growing economy. Consumer prices rose by about 3% per year in the mid-60s, up from 1 or 2% in earlier years. But this seemed tolerable, not yet a crisis requiring dramatic action. Arthur Burns became chairman of the Federal Reserve in January of 1970, succeeding William McChesney Martin. Burns was 65 years old, an economist by training, a professor who had taught at Columbia University and served as president of the National Bureau of Economic Research. He'd also worked in government, advising President Eisenhower in the 1950s, bringing both academic credentials and practical experience to the position. Burns understood inflation, had studied it, had written about the business cycle and monetary policy. He believed that the Fed could manage the economy skillfully, using monetary policy to promote growth while keeping inflation under control. He thought that the inflation of the late 60s, while troubling, could be brought down, gradually through careful policy, raising interest rates enough to slow price increases but not so much as to cause a severe recession. This gradualist approach reflected the economic thinking dominant at the time. Economists believed they understood how the economy worked. how monetary and fiscal policy could be fine-tuned to achieve desired outcomes. The success of the 1950s and 60s seemed to confirm this confidence. Recessions had been mild, growth had been steady, and it seemed reasonable to believe that careful management could continue these favourable trends. But the 1970s would challenge this confidence, would reveal the limits of what monetary policy could accomplish, would demonstrate that some problems couldn't be solved through gradual adjustments and careful calibration. The decade would become known for stagflation, a combination of stagnant economic growth and persistent inflation, something that economic theory of the time had trouble explaining and policymakers had trouble addressing. The roots of this stagflation were complex, lying partly in decisions made years earlier, partly in external shocks that no amount of skillful policy could prevent. Government spending had expanded substantially in the 1960s, funding both the Vietnam War and President Johnson's Great Society programs. This spending, not fully financed by taxes, created demand in the economy that pushed against productive capacity, contributing to rising prices. International monetary arrangements were also changing in ways that affected inflation. The Bretton Woods system, established after World War II, had fixed exchange rates between major currencies, with the dollar pegged to gold at $35 per ounce. This arrangement was breaking down by the early 70s, unable to accommodate the economic changes of the post-war decades. Countries held more dollars than the United States had gold to redeem, creating fundamental instability. In August of 1971, President Nixon announced that the United States would no longer convert dollars to gold at the fixed price, effectively ending the Bretton Woods system. Exchange rates would now float, determined by market forces rather than fixed agreements. This removed a constraint on monetary policy, the need to maintain gold convertibility, but it also removed a discipline, the limit that gold convertibility had imposed on money creation. Without the gold anchor, inflation became more purely a matter of policy choice, of how much money the Fed allowed to be created, of how much credit expansion it accommodated. And through the early 1970s, the Fed accommodated quite a bit, keeping interest rates relatively low, allowing money growth that fueled rising prices. Burns and his colleagues were trying to balance competing objectives, wanting to support employment and growth, while also controlling inflation, hoping to achieve both without making the hard choices that single-minded focus on inflation would require. Then came the oil shock of 1973. In October of that year, several Arab oil-producing countries announced an embargo on oil exports to countries that had supported Israel in the Yom Kippur War, including the United States. Oil supplies tightened, prices quadrupled within months, rising from about $3 per barrel to nearly $12. This was an external shock, not caused by American monetary policy, but it created enormous challenges for policymakers. Higher oil prices meant higher costs for businesses and households. Gasoline became more expensive, heating oil more costly, production that used petroleum products more expensive. This fed directly into inflation, pushing the overall price level up. At the same time, higher energy costs acted like a tax on the economy, reducing the purchasing power available for other spending, slowing economic growth. The Fed faced a dilemma. If it tightened policy to fight the inflation caused by higher oil prices, it would worsen the economic slowdown, increasing unemployment. If it kept policy loose to support employment, it would allow inflation to become embedded in expectations, creating long-term problems. Burns chose to accommodate the oil shock, keeping monetary policy relatively easy, hoping that oil prices would eventually decline and inflation would subside without requiring harsh medicine. But inflation didn't subside. It persisted through the middle 1970s, sometimes slowing modestly, but never falling back to the low levels of the 1950s and 60s. By 1978, consumer prices were rising at about 9% per year, high enough to create real problems, to erode savings, to complicate business planning, to create a general sense of economic uncertainty. People began to expect inflation to continue, to build those expectations into their decisions. Workers demanded higher wages to compensate for rising prices. Businesses raised prices to cover higher costs and to stay ahead of expected future inflation. This created a kind of self-fulfilling dynamic where expected inflation became actual inflation, where the belief that prices would rise contributed to their rising. The Fed under Burns tried repeatedly to slow inflation, raising interest rates, tightening credit, talking firmly about the need for price stability. But these efforts were half-hearted, insufficiently sustained, always pulled back when unemployment rose or political pressure mounted. Burns himself seemed to believe that inflation wasn't primarily a monetary phenomenon, that it was caused by factors beyond the Fed's control, by oil prices and union power and government deficits, not by excessive money growth. This belief made him reluctant to use the full force of monetary policy to fight inflation. In 1979, a second oil shock hit. Revolution in Iran disrupted that country's oil production, and prices spiked again, doubling from about $15 per barrel to over $30. This pushed inflation higher still, to levels not seen since immediately after World War II. By the spring of 1979, consumer prices were rising at about 13% per year, deeply troubling rates that threatened to spiral even higher. President Jimmy Carter, facing economic distress and declining public confidence, decided that dramatic action was needed. In July of 1979, he asked for Arthur Burns's resignation and nominated Paul Volcker to replace him as Fed chairman. Volcker was 51 years old, had worked at the Federal Reserve Bank of New York, had served as Undersecretary of the Treasury, understood both domestic monetary policy and international finance. Volcker was also known for his views on inflation. He believed it was primarily a monetary phenomenon, that persistent inflation resulted from persistent excessive money growth, that fighting it would require sustained tight monetary policy, regardless of the short-term economic pain that might cause. He was willing to make hard choices, to withstand political pressure, to take actions that would be unpopular but necessary. Volcker was confirmed by the Senate and took office in August of 1979. He inherited an economy in trouble, with inflation accelerating, productivity growth stagnant, public confidence in economic institutions and policies deteriorating. The Federal Reserve's credibility had been damaged by years of unsuccessfully fighting inflation, by promising to bring prices under control and then failing to do so. People no longer believed that the Fed would, or could, restore price stability. Volcker understood that restoring credibility required demonstrable action, not just words. In October of 1979, just 2 months after taking office, he led the Federal Open Market Committee to adopt a new approach to monetary policy. Instead of targeting interest rates, setting a desired rate, and then buying or selling securities to achieve it, the Fed would target the money supply, controlling how much money existed in the economy, and letting interest rates move to whatever levels that control required. This was a technical change in operating procedure, but it had enormous practical significance. It meant that interest rates could rise sharply, far higher than the Fed would have been comfortable setting directly, if that's what was needed to control money growth. It was a way of committing to fight inflation seriously, of tying the Fed's hands to prevent the kind of backing down that had characterized earlier efforts. Interest rates did rise sharply. The federal funds rate, the overnight rate at which banks lend to each other, which the Fed influences through its operations, had been around 11% when Volcker announced the new policy. By the spring of 1980, it had risen to nearly 20%, extraordinarily high levels that made borrowing very expensive, that slowed economic activity dramatically. The economy fell into recession. Businesses cut back on investment, finding it too expensive to borrow for expansion. Consumers reduced spending on homes and cars, unable to afford the high mortgage and auto loan rates. Unemployment rose from about 6% in 1979 to over 7% by mid-1980. The housing industry was particularly hard hit, with construction falling sharply as high mortgage rates made homes unaffordable for many buyers. The political reaction was intense. Home builders sent pieces of wood to the Fed, symbolizing the houses that weren't being built. Farmers, squeezed by high interest rates on their operating loans, protested at Federal Reserve banks. Members of Congress demanded that Volcker ease policy, complained that he was causing unnecessary suffering, questioned whether fighting inflation was worth such economic pain. Volcker stood firm. He testified before Congress, explaining that inflation had to be brought under control, that the short-term pain was necessary to prevent worse long-term problems, that the Fed would not back down as it had in the past. He had the support of President Carter initially, though that support became more ambiguous as the recession deepened and Carter faced re-election in 1980. The recession eased later in 1980, and the Fed allowed some modest relaxation of policy. But inflation remained high, still around 10%, and Volcker knew that the job wasn't finished. When economic growth resumed in early 1981, the Fed tightened again, driving interest rates back up, pushing the economy into another recession, this one deeper than the first. This second recession, beginning in the middle of 1981, was severe. Unemployment rose to over 10% by late 1982, the highest level since the Great Depression. Industrial production fell sharply. Business failures increased. The pain was widespread, affecting workers who lost jobs, businesses that closed, communities that saw their economic base eroded. But inflation was finally breaking. The rate of price increases slowed from around 10% in 1981 to about 4% by 1983. This was still higher than the low inflation of the 1950s and 60s, but it was dramatically better than the 13 or 14% of 1979 and 1980. More importantly, inflation expectations were changing. People began to believe that the Fed really would maintain low inflation, that the price stability of earlier decades could be restored. This change in expectations was crucial. Once people believe that inflation will remain low, they stop building high inflation into their wage demands and pricing decisions. This makes the Fed's job easier, allows it to maintain low inflation without constantly having to prove its resolve through high interest rates and economic pain. Volcker's willingness to accept deep recession had established credibility. had convinced markets and the public that the Fed meant what it said about inflation. The recession ended in late 1982. Economic growth resumed, unemployment began to fall, business confidence returned. But the recovery was built on a foundation of low inflation, of stable prices that allowed businesses to plan, that protected the value of savings, that removed the economic uncertainty that high inflation creates. The Great Inflation, as the period from the mid-60s to the early 80s came to be called, was over. Volcker's tenure as Fed chairman, which continued until 1987 when he was succeeded by Alan Greenspan, demonstrated both the power and the limits of central banking. The Fed had the tools to control inflation if it was willing to use them forcefully. But using those tools required accepting short-term economic pain, required withstanding intense political pressure, required making decisions that would be unpopular even if they were correct. The experience also clarified the importance of credibility. A central bank that says it will fight inflation, but then backs down when the costs become apparent, will struggle to control prices. Expectations of continued inflation become self-fulfilling, requiring even more painful policies later. But a central bank that demonstrates its commitment, that accepts short-term costs to achieve long-term stability, can shape expectations in ways that make maintaining low inflation easier going forward. The lessons from the Great Inflation and its ending shaped central banking for decades. Central banks around the world adopted explicit inflation targets, committed to keeping price increases at low, stable levels, usually around 2% per year. They granted their central banks greater independence, recognizing that political pressures often push toward excessive ease, toward prioritizing short-term growth over long-term stability. They accepted that controlling inflation was a central bank's primary responsibility, that other goals, while important, had to be pursued in ways consistent with price stability. For the Federal Reserve specifically, the Volcker years established a template for how the institution should operate in difficult circumstances. The chairman should be willing to make unpopular decisions if economic analysis supports them. The Fed should communicate clearly about its goals and reasoning, but it shouldn't simply do what politicians or the public want in the moment. Independence, won with difficulty in 1951, should be used to make decisions that serve the long-term public interest, even when those decisions create short-term discomfort. Paul Volcker became a symbol of central bank resolve, of the willingness to do what was necessary rather than what was easy. His physical presence, tall and imposing, his habit of smoking cheap cigars, his direct manner of speaking, all contributed to a public image of strength and determination. But the substance mattered more than the image. Volcker had used the Fed's tools to accomplish what previous chairmen had attempted but failed to achieve, breaking the back of inflation, restoring price stability, creating conditions for sustainable growth. When he left office in 1987, the economy was growing steadily, unemployment was declining, inflation remained low, the Fed's credibility was high. The institution he had led through the most difficult period since the Great Depression was respected, trusted to make policy decisions based on careful analysis rather than political expediency. The independence that William McChesney Martin had fought for in 1951 had been tested and reaffirmed, proven valuable not just in theory but in the crucible of actual crisis. The Great Inflation and its resolution would remain a reference point for generations of central bankers, a reminder of what could go wrong when policy was too accommodative for too long, and of what it took to correct the problem once inflation became embedded. The scars from that period, the memory of double-digit inflation and unemployment, would influence thinking about monetary policy for decades, creating a bias toward vigilance against inflation, toward maintaining the credibility that Volcker had established at such cost. Alan Greenspan became chairman of the Federal Reserve in August of 1987, succeeding Paul Volcker. Greenspan was 61 years old, an economist who had worked in private consulting, had chaired the Council of Economic Advisers under President Ford in the 1970s, was known for his careful analysis and his ability to explain complex economic issues in accessible language. He inherited an economy that was healthy, growing steadily, with inflation under control thanks to Volcker's earlier efforts. Just 2 months after Greenspan took office, the stock market experienced a sharp decline. On October 19, 1987, stock prices fell by more than 20% in a single day, the largest one-day percentage decline in the market's history. The crash was unexpected, driven by computerized trading programs and general nervousness about valuations, creating concerns that it might signal the beginning of a broader economic downturn. Greenspan's response was swift and reassuring. The Fed announced that it stood ready to provide liquidity to support the financial system, to ensure that the stock market's problems didn't spread to banks and other institutions. Interest rates were lowered modestly to ease financial conditions. The message was clear. The Fed would act to prevent a stock market decline from becoming an economic crisis. The economy barely slowed. The crash proved to be a market event rather than an economic turning point. Growth continued, unemployment remained low, and confidence returned relatively quickly. Greenspan's handling of the situation established his credibility early in his tenure, demonstrated that the Fed could respond effectively to financial disruptions. The years that followed, running from the late 1980s through the 1990s and into the early 2000s, became known as the Great Moderation. This was a period of unusually stable economic growth, with mild recessions, low inflation, steady employment gains. The volatility that had characterized earlier periods, the sharp booms and busts, seemed to have diminished. The economy grew more smoothly, more predictably. Various explanations were offered for this stability. Some credited improved monetary policy, the Fed's increased skill at using its tools to promote steady growth. Some pointed to structural changes in the economy, the shift from manufacturing to services, the adoption of better inventory management practices by businesses, globalization that made supply chains more flexible. Others suggested it was simply good fortune, a period when major shocks happened to be absent or mild. Greenspan himself seemed to believe that fundamental improvements had occurred, that the economy had become more stable, more resilient, better able to absorb disturbances without experiencing severe downturns. He spoke of a new economy in the late 1990s, driven by information technology and productivity gains, capable of growing faster than previous experience would have suggested without generating inflation. The 1990s saw the rise of the internet and related technologies, creating new industries, new business models, new possibilities that captured public imagination. Stock prices of technology companies soared, rising far faster than traditional measures of value would support. Some analysts warned of a bubble, of irrational exuberance, as Greenspan himself noted in a speech in December of 1996. But the enthusiasm continued. with investors convinced that old rules no longer applied, that technology stocks deserved higher valuations because they represented the future. The bubble peaked in March of 2000. Stock prices, particularly of technology companies, began to fall. The decline continued for more than 2 years, erasing trillions of dollars of paper wealth. Many internet companies that had seemed promising went out of business, their business models proving unsustainable, their valuations having been based more on hope than on realistic assessment of future profits. The Fed responded by lowering interest rates, easing monetary policy to cushion the economy from the effects of falling stock prices and reduced business investment. A recession did occur beginning in March of 2001, but it was relatively mild, lasting only 8 months. Unemployment rose modestly, but remained below 6%. The economy adjusted. Resources shifted from failed ventures to more sustainable activities, and growth resumed. Then came September 11th, 2001, when terrorist attacks struck New York and Washington. The immediate economic impact was significant, with financial markets closed for several days, travel disrupted, uncertainty elevated. But again, the Fed responded quickly, providing liquidity, lowering interest rates further, working to ensure that the shock didn't trigger a broader financial crisis. The economy weathered these challenges, returning to growth by late 2001. The Fed kept interest rates low for an extended period, supporting recovery, helping the economy absorb both the bursting of the technology bubble and the disruptions from the terrorist attacks. By 2004, growth was solid, employment was expanding, and the Fed began gradually raising rates back toward more normal levels. But developments were underway in housing and mortgage markets that would create larger problems. Home prices had been rising for years, faster in some regions than in others, driven by low interest rates, easy mortgage availability, and a widespread belief that housing was a safe investment that would always appreciate. Mortgage lending standards had loosened, with banks offering loans to borrowers with weak credit histories, with little documentation of income, with small or no down payments. These subprime mortgages, as loans to less credit-worthy borrowers came to be called, were often bundled together into securities and sold to investors. The securities were structured in complex ways, with different tranches having different levels of risk and return. Credit rating agencies assigned high ratings to many of these securities, suggesting they were safe investments, even though they were backed by risky mortgages. The housing boom peaked in 2006. Prices stopped rising in most markets, then began to fall. This created problems for borrowers who had taken out mortgages expecting to refinance as their home values increased. When values fell instead, refinancing became impossible, and borrowers with adjustable rate mortgages faced payment increases they couldn't afford. Defaults began to rise. As defaults increased, the securities backed by these mortgages lost value. Investors who had thought they owned safe assets discovered they held troubled ones. Financial institutions that had invested heavily in mortgage-backed securities faced losses. Some institutions had borrowed heavily to make these investments, using leverage that magnified their losses when asset values fell. Through 2007, financial stresses built. Some hedge funds that had invested in mortgage securities collapsed. Some mortgage lenders went out of business. But these seemed like isolated problems, difficulties in particular sectors rather than threats to the broader financial system. The economy continued to grow, unemployment remained relatively low, and many observers believed the problems would remain contained. In March of 2008, Bear Stearns, a major investment bank, faced a funding crisis. The firm had significant exposure to mortgage-backed securities, and as concerns about those securities grew, Bear Stearns found it increasingly difficult to borrow the money it needed to conduct its daily operations. The Federal Reserve, working with the Treasury Department, helped arrange for JP Chase to acquire Bear Stearns, preventing a disorderly failure that might have created broader disruptions. The situation deteriorated through the summer of 2008. More financial institutions faced difficulties. Fannie Mae and Freddie Mac, government-sponsored enterprises that played central roles in the mortgage market, were placed into government conservatorship in September. Lehman Brothers, another major investment bank, filed for bankruptcy on September 15th, unable to find a buyer or arrange a rescue. This was a significant development, the largest bankruptcy in American history, creating uncertainty about which other institutions might be vulnerable. The Federal Reserve faced circumstances it had never confronted before, at least not since the Great Depression. The traditional tools of monetary policy, lowering the federal funds rate and providing liquidity through the discount window, seemed insufficient for the scale of the problems. The Fed needed to be more creative, more aggressive, willing to use its powers in novel ways to support the financial system. Ben Bernanke had succeeded Greenspan as Fed chairman in February of 2006. Bernanke was 52 years old, an economist who had taught at Princeton, who had served on the Federal Reserve Board before becoming chairman. His academic work had focused on the Great Depression, on understanding how financial crises could deepen economic downturns, on what central banks should do to prevent such outcomes. Bernanke's scholarship would prove directly relevant to the challenges of 2008. He understood that financial crises could create credit crunches, could prevent sound borrowers from getting loans, could turn financial sector problems into broad economic contractions. He believed the Fed had to act forcefully to prevent this, to keep credit flowing even when private markets were dysfunctional. The Fed lowered the federal funds rate aggressively through late 2007 and 2008, bringing it close to zero by the end of the year. But with rates already so low, there was little room for further conventional monetary easing. The Fed needed additional tools, new approaches to providing monetary stimulus, when the traditional method of lowering short-term interest rates had been exhausted. The solution was quantitative easing, a policy of purchasing long-term securities, government bonds and mortgage-backed securities in large quantities. By buying these securities, the Fed would push up their prices and push down their yields, lowering long-term interest rates even when short-term rates were already at zero. This would make borrowing cheaper for businesses and households, stimulating spending and investment. The Fed announced its first quantitative easing program in November of 2008, committing to purchase hundreds of billions of dollars of mortgage-backed securities and treasury bonds. Additional programs followed in 2010 and 2012, with the Fed's balance sheet, the total value of assets it held, expanding from less than $1 trillion before the crisis to more than $4 trillion at the peak of its purchases. This was unprecedented in scale, a massive expansion of the Fed's role in financial markets. The Fed was now the largest holder of Treasury securities and mortgage-backed securities, its purchases dwarfing those of any private investor. Critics worried about the consequences, about whether such massive money creation would lead to inflation, about whether the Fed could eventually unwind these positions without disrupting markets. But Bernanke and his colleagues believed the risks of doing too little exceeded the risks of doing too much. The economy had fallen into a severe recession, the worst since the Great Depression. Unemployment rose from about 5% in early 2008 to 10% by late 2009. Millions of jobs disappeared, businesses closed, families lost their homes to foreclosure. The Fed's aggressive actions, combined with fiscal stimulus from the federal government, helped stabilize the economy and support recovery. Growth resumed in the second half of 2009, though it was slower than after typical recessions. Unemployment declined gradually over the following years, falling below 6% by 2014, though it took much longer to reach the low levels that had prevailed before the crisis. Quantitative easing became a standard tool of monetary policy, not just in the United States but in other countries as well. The European Central Bank, the Bank of Japan, the Bank of England all adopted similar programs when their economies faced difficulties and conventional interest rate cuts were insufficient. What had seemed radical and experimental in 2008 became accepted practice, part of the central banking toolkit. The financial crisis also led to regulatory changes, new rules designed to make the financial system more resilient. Banks were required to hold more capital to maintain larger buffers that could absorb losses without threatening their solvency. New oversight mechanisms were created to monitor risks across the financial system, not just in individual institutions. The Fed itself took on additional supervisory responsibilities, becoming more involved in ensuring the safety and soundness of the largest financial institutions. These changes reflected lessons learned from the crisis, understanding that financial stability required more than just appropriate monetary policy. It required sound regulation, careful supervision, rules that prevented excessive risk-taking and ensured that institutions could withstand shocks. The Fed's role expanded beyond managing interest rates and the money supply to include responsibility for the broader health of the financial system. Bernanke's chairmanship, which lasted from 2006 to 2014, was defined by crisis management and innovation. He had steered the Fed through the most challenging period since the Great Depression, had developed new tools when conventional ones proved inadequate, had prevented what might have been a second Great Depression from occurring. His academic study of historical crises had prepared him, in a sense, for the practical challenges he would face, allowing him to apply lessons from the past to present circumstances. Janet Yellen succeeded Bernanke in 2014, becoming the first woman to chair the Federal Reserve. Her tenure focused on continuing the recovery, gradually raising interest rates as the economy strengthened, beginning the process of reducing the Fed's balance sheet. The economy grew steadily through her 4 years as chair. Unemployment fell to very low levels, and inflation remained close to the Fed's 2% target. Jerome Powell became chairman in 2018, continuing the gradual normalization of policy, but the Fed's role had been permanently changed by the crisis and its aftermath. Quantitative easing was now an established tool, available when needed. The Fed's balance sheet was much larger than before the crisis, holding trillions of dollars of securities. The institution's responsibilities for financial stability were more explicit, codified in law and regulation. The modern Federal Reserve, shaped by the experiences of the 2008 crisis, was more active, more willing to intervene, more creative in using its tools than the institution of earlier eras. The caution that had characterized the Fed during the Great Depression, the reluctance to act aggressively, had been replaced by a bias toward action, toward using the full range of available tools to promote economic stability and growth. This evolution reflected accumulated learning, decades of experience with monetary policy under different conditions, study of past successes and failures. The Fed of 2020 was a far more sophisticated institution than the Fed of 1914, not just because it had more tools, but because it understood better how to use them, when to act boldly and when to exercise restraint, how to balance competing objectives and navigate complex trade-offs. Yet core principles remained constant. The Fed's independence, won with difficulty in 1951 and reaffirmed through subsequent decades, continued to guide its operations. The commitment to price stability, established painfully in the early 1980s, remained central to its mission. The understanding that financial stability mattered, that credit crunches and banking crises could deepen recessions, informed its approach to supervision and crisis management. The Federal Reserve had become what its creators had envisioned but could not fully specify. An institution capable of providing monetary and financial stability, of preventing panics, of smoothing economic fluctuations, of adapting to changing circumstances while maintaining core values. It remained imperfect, certainly, still learning, still facing new challenges that required new responses. But it had proven resilient, had survived crises, had evolved with the economy it served. The Federal Reserve that exists today, more than a century after its creation, operates largely invisibly in American life. Most people never think about it unless there's news about interest rate changes, unless the chairman testifies before Congress, unless some economic crisis brings it into public attention. But the Fed is there, constantly, working in the background of the economy, performing functions that touch nearly every financial transaction. Consider an ordinary day in your life. You wake up, perhaps check your bank account on your phone, seeing the balance that represents your savings, your recent paychecks, your available funds. That bank account exists within a system regulated by the Federal Reserve, insured by the FDIC up to certain limits, part of a network of financial institutions that the Fed supervises and supports. You might pay some bills electronically, transferring money from your account to pay for utilities, rent, credit card balances. These payments flow through systems operated or overseen by the Fed, moving money between banks, settling accounts, ensuring that funds move smoothly from payer to payee. Most of this happens instantly or within hours, so routinely that you don't think about the infrastructure that makes it possible. If you use a credit card to buy groceries, the transaction again passes through payment networks that connect to the banking system, ultimately settling through Federal Reserve accounts. If you deposit a check using your phone's camera, that check is processed through systems the Fed has helped develop and maintain, converting a physical instrument into an electronic record, moving funds between institutions. All of this works smoothly, reliably, because the Federal Reserve provides the foundation for the payment system. Banks hold accounts at their regional Federal Reserve Bank, and these accounts are used to settle transactions between institutions. When you wire money, when your paycheck is deposited, when you pay your credit card bill, somewhere in the chain of events, funds move between accounts at the Fed. balancing what one bank owes, another maintaining the flow of money through the economy. This payment system function is one of the Fed's oldest roles, dating back to its creation in 1913. Before the Fed, moving money between regions was complicated, expensive, sometimes unreliable. The Fed created a national payments network, standardized clearing procedures, made it possible to move funds efficiently across the country. Over the decades, the system has evolved, incorporating new technologies, becoming faster and more sophisticated, but still serving the same essential purpose. The Fed also implements monetary policy, the function that receives the most public attention. 8 times per year, the Federal Open Market Committee meets in Washington to decide on the appropriate stance of policy, whether to raise interest rates, lower them, or keep them unchanged. The FOMC consists of the 7 members of the Board of Governors, plus 5 of the 12 regional Federal Reserve Bank presidents, rotating so that all regions have input over time. These meetings follow a regular pattern. Staff economists present their analysis of current economic conditions, showing data on employment, inflation, GDP growth, financial market conditions. They offer forecasts of where the economy is heading, what trends seem to be developing. The committee members discuss this information, debate what it means, consider what policy would best serve the Fed's objectives. Those objectives are defined by Congress in what's called the dual mandate: maximum employment and stable prices. The Fed is supposed to use its tools to promote both goals, to help the economy create jobs for everyone who wants to work, while keeping inflation low and predictable, usually around 2% per year. These goals can sometimes conflict, requiring judgment about how to balance them, when to emphasize one over the other. If the economy seems to be slowing, if unemployment is rising, the FOMC might lower interest rates to stimulate activity, to encourage borrowing and spending and investment. If the economy is running hot, if inflation is accelerating, the committee might raise rates to restrain demand, to prevent prices from rising too rapidly. The decisions are based on analysis, on data, on the committee members' collective judgment about what will best serve the public interest. Once the FOMC makes a decision, that decision is implemented through operations in financial markets. If the committee wants to lower interest rates, the Fed's trading desk in New York will buy Treasury securities, injecting money into the banking system, pushing down the federal funds rate, the overnight rate at which banks lend to each other. If the committee wants to raise rates, the process works in reverse, with the Fed selling securities or using other tools to push rates higher. These operations are technical, conducted by specialists who understand market microstructure, who know how to achieve the desired effect efficiently, but the impact ripples through the entire economy. Changes in the federal funds rate affect other interest rates, on mortgages and auto loans and business credit. Higher rates make borrowing more expensive, tend to slow spending. Lower rates make borrowing cheaper, tend to encourage activity. The Fed also supervises banks, examines their operations, ensures they're following regulations, checks that they're maintaining adequate capital and managing risks appropriately. This supervisory role has grown over the decades, particularly after the 2008 financial crisis highlighted the importance of preventing problems before they become crises. Teams of Fed examiners visit banks regularly, review their books, assess their risk management practices, issue reports on their findings. For the largest, most complex financial institutions, this supervision is continuous and intensive. The Fed has staff permanently assigned to major banks, monitoring their activities, watching for emerging risks, ensuring that these institutions whose failure could threaten the broader financial system are being operated safely. For smaller banks, supervision is less intensive but still regular, with periodic examinations and ongoing oversight. The regional structure of the Federal Reserve System, with 12 Federal Reserve banks spread across the country, serves important purposes beyond just distributing operations geographically. Each regional Fed has its own research staff, economists who study their region's economy, who understand local industries and conditions, who provide perspectives that complement the national view from Washington. The regional Feds also connect with businesses, community organizations, and local leaders, gathering information about economic conditions on the ground. The presidents of the regional Feds, who participate in FOMC meetings and contribute to policy discussions, bring these regional perspectives, ensuring that national policy considers conditions across the diverse American economy. This federal structure, the balance between central coordination and regional input, reflects the compromise that created the Fed in 1913. It remains valuable more than a century later, providing a way to gather information broadly, to consider different perspectives, to avoid the concentration of power and perspective that a fully centralized institution might create. The Federal Reserve's headquarters in Washington, the Eccles Building, houses the Board of Governors and much of the staff that supports their work. Economists research monetary policy questions, studying how the economy responds to interest rate changes, how inflation expectations form and evolve, how financial conditions affect real economic activity. Lawyers work on regulatory issues, drafting rules, interpreting statutes, ensuring that the Fed's actions rest on solid legal foundations. Operations specialists manage the systems that process payments, clear checks, move money through the economy. The work is often technical, detailed, requiring deep expertise in economics, finance, law, computer systems. The people who do this work are generally not seeking publicity or recognition. They're motivated by a sense of public service, by intellectual interest in complex problems, by the satisfaction of contributing to economic stability and prosperity. The Fed competes for talent with private sector firms that can pay much higher salaries, but it attracts capable people nonetheless, drawn by the mission and the significance of the work. The chairman of the Federal Reserve, whoever holds that position at any given time, serves as the public face of the institution. The chairman testifies before Congress regularly, explaining the Fed's policies, answering questions about economic conditions, defending the institution's actions and decisions. The chairman gives speeches, meets with other central bankers, represents the Fed in international forums, communicates with the public about the economy and the Fed's role in it. But the chairman, while important, is just one part of a large institution. The Board of Governors makes decisions collectively, not by the chairman's decree. The FOMC includes voices beyond the board, with regional Fed presidents contributing their perspectives. The staff provides analysis and recommendations, though the policymakers retain ultimate decision authority. The Fed operates as an institution, with processes and procedures, with checks on individual power, with accumulated wisdom that survives leadership changes. This institutional character provides stability and continuity. Chairmen come and go, serving terms of years but not decades. Board members rotate through, some serving full 14-year terms, others leaving earlier for other opportunities. But the institution persists, maintaining its functions, preserving its expertise, carrying forward its understanding of how to promote monetary and financial stability. The independence that the Fed enjoys, hard won over decades, remains fundamental to its effectiveness. Congress could change the Fed's mandate, could modify its structure, could constrain its actions. But within the framework Congress has established, the Fed makes its own decisions about monetary policy, about how to pursue its objectives, about when to act and when to wait. This independence is not absolute. The Fed operates under laws passed by Congress. Its leaders are appointed by the President and confirmed by the Senate. It reports regularly to Congress, explains its actions, subjects itself to oversight and criticism. But on the day-to-day decisions about interest rates, about the money supply, about how to respond to evolving economic conditions, the Fed decides for itself, based on its analysis of what will best serve the public interest. The value of this independence lies in protecting monetary policy from short-term political pressures. Elected officials facing elections have incentives to prefer easy money, low interest rates, policies that make the economy feel good in the near term regardless of long-term consequences. If the Fed simply did what politicians wanted, it would be too easy for too long, creating inflation and boom-bust cycles. Independence allows the Fed to make decisions with a longer horizon, to accept short-term pain when necessary to achieve long-term stability, to resist pressures that would undermine sound policy. The institutional memory of the Great Inflation, when the Fed was too accommodative for too long, reinforces the importance of this independence, reminds policymakers of what can go wrong when monetary policy becomes politicized. But independence also requires legitimacy, requires that the Fed operate transparently, that it explain its decisions, that it remain accountable within appropriate bounds. The Fed publishes minutes of FOMC meetings, releases transcripts with a 5-year lag, holds press conferences where the chairman answers questions from journalists, testifies before Congress multiple times per year. This transparency helps maintain public trust, allows oversight without micromanagement, provides accountability without surrendering the independence needed for effective policy. The modern Federal Reserve touches your life in ways you rarely notice. When you swipe a card to pay for coffee, the payment system works smoothly because of infrastructure the Fed provides and oversees. When you check your savings account and see your money safely held, that safety rests partly on Fed supervision of the banking system and on deposit insurance that the Fed helped create. When you apply for a mortgage or a car loan, the interest rate you're quoted reflects, among other things, the Fed's monetary policy decisions. The institution operates continuously, year after year, decade after decade, performing functions that keep the economy running smoothly. Most of the time, if the Fed is doing its job well, you don't think about it at all. The bills get paid, the checks clear, the bank accounts hold your money safely, the economy grows at a reasonable pace, inflation stays low enough that you don't worry about it constantly. This quiet, steady operation is perhaps the Fed's greatest achievement. More than a century after its creation, after surviving depressions and wars and financial crises, after making mistakes and learning from them, after evolving from a controversial experiment into an established institution, The Federal Reserve has become part of the infrastructure of American economic life. It's there, working in the background, providing stability, managing money, supervising banks, facilitating payments, pursuing the dual mandate of maximum employment and stable prices. The work continues day after day, year after year. The FOMC meets according to its schedule. The regional feds serve their districts. The payment systems process transactions. The supervisors examine banks. The economists research policy questions. The lawyers draft regulations. All of this happens largely out of public view, noticed mainly when something goes wrong or when major policy changes draw attention, and perhaps that's appropriate. The best infrastructure is often invisible, noticed only when it fails. Roads carry traffic smoothly until a bridge collapses. Electrical grids power daily life until a blackout strikes. Payment systems move money effortlessly until a cyber attack disrupts them. The Federal Reserve, when functioning well, provides monetary and financial infrastructure that supports economic activity without drawing attention to itself. The institution will continue to evolve, to face new challenges, to adapt to changing circumstances. Financial innovation creates new forms of money, new payment methods, new risks that supervisors must understand and address. Climate change creates economic uncertainties that monetary policy may need to consider. International developments affect the American economy in complex ways. The Fed will need to respond to all of this, to learn and adapt while maintaining its core mission. But for now, tonight, as you drift towards sleep, the Federal Reserve is there, operating through the night in some ways, resting in others, ready to resume tomorrow the quiet, essential work of maintaining monetary and financial stability. The institution that began more than a century ago as a solution to recurring financial panics has become a permanent part of American economic life. Imperfect but functional, powerful but accountable, independent but transparent, serving purposes its creators understood but could not fully anticipate. And so the story flows onward, through more than a century of quiet evolution, through challenges met and lessons learned, through the patient work of building something that endures. The Federal Reserve, like all human institutions, is imperfect, still learning, still adapting to circumstances that no one could fully predict. But it persists, serving purposes that connect to your daily life in ways both visible and invisible. You've journeyed through panics and reforms, through wars and depressions, through innovations and crises, through the slow accumulation of wisdom that comes from experience. The people who built this institution, who struggled with impossible choices, who learned from failure and adapted, they were doing what humans have always done, trying to create stability, trying to build systems that serve the common good, trying to leave something better for those who follow. Your money, resting safely in your account, carries forward this long history. The payments you make, the savings you accumulate, the economy that surrounds your daily life, all of it rests on foundations built slowly, patiently, over generations. The work continues tomorrow, steady and quiet. But for now, there's nothing more you need to understand, nothing more to hold in your mind. The story is complete enough. The journey is finished. Let it all drift away now, gently, easily, into the soft darkness of rest. Sleep well.